Hello.
Hello.
Hi, Aditya.
Hi, Aditya. Sandeep Raichuria here.
Hi, Sandeep. Hello.
Hi, Mayur.
Hi.
I am slated to speak, I think, around 11:15. So is it all right if I keep myself on mute for some time?
Yeah, that would be great. Yeah, that would be fine.
Okay.
Hi, Pranav.
Hello. Hi, Aditya.
Hi.
How are you? Good?
Good.
Yeah. So what's the schedule now?
I have the schedule, like you will speak for around 40 minutes and then we have uh, just one sec. Yeah, Mayur speaking and after that Sandeep is speaking.
Okay, fine.
There were two sessions before that, right?
Yeah.
Two sessions before.
So initially we have a taxation series from Pranav, and after that we'll have a derivative series from you,
Right.
and
No, derivative series is not. When mine would be PMS and wealth management.
okay. Okay, I'll just correct it. So we have a derivatives series in second, and then we have your session.
Right. Okay. Okay.
Apologies for that.
हेलो. हाँ हाँ हाँ. अच्छा स्पेक्स ले. नहीं मैं गेट पे नहीं आ सकता, मेरा भी मीटिंग, आपको ऊपर आना पड़ेगा प्लीज. हाँ अप्रूवल दिखा रहे, मैं पहचाना ही नहीं कौन है, तो मैं मुश्किल अप्रूवल उनको बोलो ना वापस एंटर करने को, मैं करता हूँ अप्रूवल.
Good morning, everyone. Thanks for joining, and we are gathering, so we'll just give couple of minutes and we'll start the session. Thanks so much.
Al.
Good morning, all. A warm welcome to everyone. And this is Aditya Agarwal, and I will take the session ahead. Um, Think Tank chapter. So this is basically one of the sessions we have in the series of Think Tank chapter, and Think Tank has been in existence since decade with conferences, conclaves with CEOs, CXOs, CFO panelists. Our panelists are finance leaders working in reputed companies since many years and have deep domain knowledge. Think Tank platform has now crossed 15,000 views through its digital medium. Our participants and experts with rich experience in industry and professions who have done who has different qualifications such as ICWA of CA of England and Wales, CPA, CFA, CFAs, IMs, Chartered Accountant, Company Secretaries, CMAs, CISA, DISA, FRM, and many others. We have people from global experiences sharing experience and knowledge consistently over a decade now. Our initiative, uh, like we have started one website also, thinktanks.co.in, and as participants are aware, today we will cover topics on taxation series with latest development, think tank derivative research, the good, bad, and the ugly part of derivative, PMS and the wealth fund management perspectives with opportunities from multidisciplinary teams. Uh, sorry, IPO reviews and corporate series with real life examples. We will also be covering important and the latest development as suggested by many participants in the coming weeks. We request all to subscribe to Think Tank's YouTube channel for watching webinar conclaves and join, connect, and network on the Think Tank webinar group on LinkedIn and Facebooks. Uh, Specially created on suggestions by different participants. We once again welcome all members and panel speakers and start the taxation series. We welcome Pranav. Hi, Pranav. Yeah, I think you're on mute. Yeah, that's
Yeah.
great. You want to share your screen on your presentation?
I
That
will
would be great.
yeah. It's visible?
Very much visible. Correct.
Should we start, Aditya? Or we should?
Yeah, Pranav, please.
Okay.
Yeah, Pranav, you can.
Fine, fine. So I'll just take up this part. Good morning, everybody. Welcome to Think Tank. The India growth story continues. And today, in the series of the taxation related topics, we have a topic on GST today. And basically, today, the topic which has been selected and which was wanted by many of the participants was notices and assessments under GST. Compliances under GST have become a very big task, and people need to remain updated and remain very compliant under the GST law. GST law is dependent on the self-assessment system, and that is why there is a big stress on compliances under GST. And once these compliances are through, well, there will be lesser notices and lesser assessment. But if the compliances are not at their place, then of course there are bound to be notices and assessments under GST. And of late, many notices have been received by the various dealers registered under the GST law. And we really need to understand the different types of notices, the different types of assessments, and audits under the GST regime. We'll go through that one by one. Of course, these are the standard slides about Think Tank, which are given over here. And this is about Think Tank. This is being shared in every meeting, so I'm not going through this. And it has also been mentioned by Aditya about Think Tank. Well, let's get straight away to the topic for today, which is assessments and notices under GST. So, what do you mean by assessment under GST? Assessment means determination of tax liability under this act and includes self-assessment, reassessment, provisional assessment, summary assessment, and best judgment assessment. Now, what are all this? Basically, self-assessment, as we all can understand, it is an assessment made by the registered person himself or herself. So while filing the GST returns every month or every quarter, whatever taxes the registered person calculates, reflects in the GSTR1 and GSTR3B returns and uploads on the portal and pays the tax thereon, that is the self-assessment that is made by the registered person itself. Then what is provisional assessment? It is an assessment undertaken at the instance of the registered person, followed by a final assessment. So it is a request which is made by the registered person that a provisional assessment may be made in his case. It is a action which is made, a request which can be made by the dealer himself, that he wants to get assessed for a particular type of issue. And then he can get himself assessed provisionally. We'll come to in details of what is a provisional assessment and what all is covered under provisional assessment. Then there is a scrutiny of returns filed, which is done by the department, where the officer checks the correctness of the returns filed and intimates the registered person of any discrepancies noticed. And this is where most of the notices are coming nowadays, because they have started scrutiny of the returns. They are reviewing 3B, they are reviewing the GSTR1, they are reviewing what is getting uploaded in GSTR2A, and whatever discrepancies they are finding, based on that the notices are being issued. We'll come to the types of notices and what all is covered under scrutiny. This is just the beginning. And there is an assessment of unregistered persons. Say there could be dealers who are liable to get registered, but they are carrying on business without being registered under the GST law. And the department finds out that there are such certain people who are doing business, who are required to get registered under the GST law, but are not registered under GST, and they can take up the assessment of such unregistered persons also. There are special powers for that. And summary assessment in certain special cases. Now, where the officer feels that there is a scope of tax evasion, or the person whom he has whom he has caught, or whom he has identified may hive off his assets, and then he wants to take up a summary assessment. There are special provisions for summary assessment, but that too in special cases, that too with the approval of the higher authorities. It cannot be in general by any by the assessing officer per se, or by the STO, or the superintendent, or the inspector. There has to be a special permission to take up the summary assessment from the joint commissioner or the additional commissioner. Then only such assessments can take place. Apart from assessments under GST, there is also the concept of audit under GST. So what is the difference between audit and assessment? Audit means the examination of records. See, assessment was to determine the tax liability, but audit is examining the records, returns, and other documents. So it has a wider perspective, and to verify the correctness of the turnover declared, taxes paid, refund claim, and the input tax credit availed. So these are the purposes of audit under GST, and both these definitions of assessment as well as audit are defined under the GST law. What do you mean by assessment and what do you mean by audit? So it is not just a general remark or a general statement. These both are specific definitions which are given under the GST law, and basically to assess the compliance with the provisions of the Act and rules. So basically this is the purpose of the audit. So just to differentiate between the audit and the assessment. So if we see the scope for audit, the audit is to verify correctness of the turnover declared, taxes paid, refund claim, and input tax credit availed, and the compliance is thereof. Whereas the assessment would lead to determination of the tax liability. Audit will not directly lead to determination of tax liability. Audit will lead to generating a report and mentioning or identifying the issues about leviability of tax. But determination of the actual tax payable would come through the assessment. And that is what one of the major difference between the audit and the assessment. Again, under audit, I think there are two types of audit. One is section 35(5), which is audit by a chartered accountant or a cost accountant. And the second is audit under section 65, which is the audit by the tax authorities. So there is a departmental audit and there is a tax audit, or there is an audit by a professional of the records of the dealer. Whereas under assessment, there are various sections which are self-assessment, provisional assessment, scrutiny, assessment of non-filers. That is again a different thing, assessment of non-filers. So a person is registered under, being registered under the GST law, but not filing returns. For them, there is a special provision for assessment of non-filer of return. Again, there are special provisions for that. Assessment of unregistered persons, which we saw earlier, and summary assessment in special cases. So these are the types of assessment versus the types of audit, which is all envisaged in the respective sections under the CGST Act. And of course, the authority, as we discussed earlier, for the audit, one is the audit by a chartered accountant, other is the adjudicating authority where the audit will be conducted, and assessment has to be by a proper officer. So everybody will feel why this word is proper officer. This is what is defined under the GST law, that the officer has to be proper. The assessment may or may not be proper, but the officer has to be a proper officer. That means the designated officer who has been allocated and given the task of doing a particular assessment of a particular dealer. Any person or any officer cannot do assessment of any dealer. He has to be given the power to do that assessment. He has to be delegated the task of doing that assessment, and that delegated task to the delegated officer, that will be the proper officer who will be doing the assessment, right? So we have to understand proper officer in that manner. In general, under income tax, we tell him the assessing officer. Okay. So what are the conclusions which come from that audit or the assessment? As I told earlier, the CA who will be doing the audit under CA or CMA who will be doing the audit under the basic provisions, he will report in GST as 9C. Of course, you all might be knowing that this GST 9C will be applicable till it is amended as per the Union Budget 2021. Recently in the budget, this audit under GST is going to get replaced as announced in the budget. It will be replaced with a self-certification by the RP. RP, here we need to understand RP not as a resolution professional, because many are IBC professionals over here. But we need to understand this as a registered person. So it will be replaced by a registered person. Basically, I think more onus has been cast on the registered person himself to submit the reconciliation statements. Basically, in audit, reconciling them with the books of accounts is a bigger task which needs to be done. This self-certification, what I feel and I understand is that this self-certification by the registered person under GST will be almost akin to the current GST audit report in GSTR 9C. We will wait for the report format which will be announced by the government. But till that point of time, or maybe when it comes, we can again review it at that point of time. But basically, some authenticity to ensure that the data in the returns which are filed by the dealer, which are there in the annual return, right? That data needs to be matched with your books of accounts. That authenticity has to come, because if you file a turnover X in the GST returns and there's a turnover Y in books of accounts, and if there is no reconciliation between the turnover X to turnover Y as mentioned in the books of accounts, then your data, that it may not be proper to do an assessment, or the officer may feel that your GST returns are incorrect. He may make a best judgment assessment and issue notices for further assessments. So it is better to get them reconciled with the financials, and self-certification, I feel it will again lead to the same processes or tasks which are there under GSTR 9C, which will be replaced. But processes, I think, will definitely continue to be the same. And many companies would themselves ask their auditors themselves to reconcile the 9C, and based on the internal certification from the officer, the companies may self-certify their GSTR 9 or the new form, whatever the name or the number of that form may come. That would come. So that is the future of this self-certification. Let's see how things evolve around it. As far as the audit by the department is concerned, the notice or the completion would come in the GST ADT2 form. And as far as the assessment of the dealer is concerned, there will be an entire ASMT series. The forms will be issued in the ASMT series. There's a series of forms which will be issued by them in the ASMT series. We can go through those. Of course, the action post the audit which happens, because the audit of the professional, it will be recommendatory in nature. GSTR 9C, whatever is recommended by the auditor, the dealer may or may not accept. And Section 65 will also, the Section 65 audit here, I think here again we need to really understand, when there will be a department audit, the authorities per se first will identify the issues. The dealer may agree to those issues, may not agree to those issues. If the dealer agrees and pays the tax, the audit point will be closed. If the dealer does not agree to the points raised by the audit authorities, that will lead to the next step of raising a show cause notice to the dealer. And that is where the next step of audit would come, that is a show cause notice. Similarly, under assessments also, there is going to be a similar procedure, because we saw that assessments and audit are a separate part. Both after completion of the assessment and the audit, the process of show cause notice issuance starts, which is covered by Section 73 and 74 of the CGST Act. Right. So both these proceedings are the basic proceedings. And if the dealer agrees to those proceedings, he may pay the tax. If he does not agree, then there will be a show cause notice, then attending and replying to the show cause notice. Again, it will be adjudicated by the respective authority. And if the dealer does not agree with the order which would come from the issuance of the show cause notice, the final order, then he has the next recourse of action, that is to file an appeal to the appellate authority, right? So if we see on both the sides, at one side there is, on one side there is an audit, on the other side there is an assessment, and these assessments are prima facie assessments and not the assessment as we see under the income tax law. I think here we need to really understand and differentiate between the assessments under the Income Tax Act and the assessments under the GST law. Assessment under the Income Tax Act means it's going to be a full-fledged assessment of income tax notice would come, say under section 143.2, the notice comes, and 143.3, all those sections. Then there's a full-fledged assessment of the dealer right away, and the next step leads to filing of an appeal if the dealer does not agree or paying the taxes. But under GST, there is a difference. There will be first either an audit or an assessment. The nomenclature of the audit or the assessment is different. We saw there are two types of audits, and assessments are of various types that we saw in the previous slide. And those are based on the prima facie data available with the department or with the dealer. And then if there is a disagreement between the department and the dealer, then only the show cause notice stage comes, and then only that stage would further lead to filing of the appeal to the appellate authority, right? So there's a difference in that we need to understand. If we try to correlate this with the indirect tax regime, under excise and service tax, similar procedures were there. Audit was there, or rather assessment was not there, audit was there, and then issuance of show cause notice would arise. But under VAT regime, say especially in Maharashtra, under VAT regime, there was a direct assessment only. Audit provisions were there, but they were never applied. There have been certain specific audit cases which are by way of issue-based audits. In issue-based audit, there's a specific notice which is issued to the dealer for, say, mismatch in your input tax credit by J1, J2 mismatch, which is called, or non-production of declaration forms. That covers under the issue-based audit. And the balance is a full-fledged notice which is issued for the assessment purposes. So assessments under VAT is different. Service tax and excise, it is different. GST is again going to be a different process, and income tax is a different process. So we really need to understand with respect to each of those notices. Now let's understand the various reasons for the GST notices. I'm not going through all the slides because the slides are available with you all, and the PDF thereof can be shared with the participants. I would like to take up the main issues first with respect to the GST notices which are being issued. The first kind of notice which has started rolling is mismatch in the details reported between the GSTR1 and GSTR3B, which is again a scrutiny notice. So whatever discrepancies are there, so GSTR1, I think everybody would be aware, GSTR1 is the returns of details of outward supplies. Whatever sales of goods are made or whatever services are provided by the dealer, that details are mentioned in GSTR1. Then there's a separate return, there's a GSTR3B return, which is a summary data which is mentioned in the GSTR3B. It is not a detailed line item wise details which are given in that GSTR3B. It's a gross amount or a lump sum amount of the taxable value and tax payable thereon under respective categories, which is mentioned in GSTR3B. Both these returns are filed separately by the dealer. In case if there is any mismatch in both, then there's a notice which will be issued to the dealer, GSTR1 versus GSTR3B, and that notices have started flowing. The dealer will have to identify the discrepancies, either rectify his GSTR1 or the GSTR3B, and if required, pay the taxes thereon. In one of the amendments which have been made in these returns, in case if there is going to be any discrepancy between GSTR1 and GSTR3B, again a notice will be issued to the dealer and the dealer will be asked to pay the tax thereon immediately. So these provisions or these amendments have come in the recent budgets. Then there are differences in input tax credit claims made in GSTR 3B versus GSTR 2A. Similarly to what was there for outward supplies in the first point, with respect to the inward supplies on which input tax credit is going to be claimed by the dealer, the department is matching that data, because see how the process works, that whatever data is uploaded by a seller in GSTR 1 will be auto-populated in GSTR 2A of the purchaser or the recipient of the goods or the services. The recipient of the goods or services would have filed his GSTR 3B monthly return, right? There the matching will happen of GSTR 3B with GSTR 2A, or rather that matching has already started. We know that Rule 36(4) became effective from 1st October 19. In October 19, this rule mentioned that in case if there is a difference up to 20% between the input tax credit claimed in GSTR 3B versus what is available in the auto-populated GSTR 2A of the dealer, to the extent of 20% difference, that difference will be allowed to be taken as an excess input tax credit. Right. So in case if in GSTR 3B a credit of 10,000 has been claimed, but in GSTR 2A the credit of only 6,000 is getting reflected. 20% of that, 1,200. So dealer will only be able to claim the credit of 7,200 and not 10,000 rupees in that case. But that remained only for 3 months, from October 19 till December 19. Thereafter, on 1st January 2020, that limit became 10%. On 1st January 21, that limit became 5%. And now it is proposed to make it 0. Right. So whatever will be matching in GSTR 2A, that credit will only be allowed to be taken by the registered dealer. Other credits will not be allowed to be taken. How much justified this is, whether this rule can be challenged constitutionally, whether this rule is a valid rule, or whether this provision which is now proposed to be inserted in the main CGST Act in section 2, they are going to insert a proviso for this. How valid that is, I think that time will tell. Somebody can really challenge this. And the basic virus of challenging this is that as a recipient of the goods or services, I only get the tax invoice along with my goods or services of the dealer. I, as a recipient, have no control of the other person filing his GSTR 1, right? Because in GSTR 2A, the data gets auto-populated from the GSTR 1, which will be filed by the seller. If the seller does not file GSTR 1 and does not pay the taxes, how as a buyer am I going to control that? I have no control over that. And I think that becomes a task impossible. Now, within this task impossible, which is cast upon the dealer, who is an individual or who could be a company, whomsoever, but he has no control on the other person. Of course, the government has a control of attaching the property of that person, cancelling his registration number, recovering the amount from him, that is the seller. But the buyer, the poor buyer, does not have control over that dealer, except, of course, which most of them are doing, they keep on hold certain payment which is due to the seller. Right? Except for that, there is no other control which is available with the buyer. Of course, then there are other provisions which go on to say that if the payment is not made to the seller of the goods within 180 days, then also the input tax credit will not be allowed. Right? So the buyer is generally, in such situation, it becomes very difficult for the buyer. The working capital thereof of the input tax credit gets blocked to the extent of input tax credit. And matching and reconciling this details on a day-to-day basis, on a monthly basis, or even on a quarterly basis is a humongous task. Especially where there are lots of inputs and input services which are being received by the dealer. There could be industries which are having so much of expansion. They are into capitalization mode, setting up their factories and building up huge plants and machineries and so many things, right? So for those cases, it really becomes difficult to keep a track of the credit. Nonetheless, this is the rule which is applicable as of now, and the government expects compliance. wherever they are seeing non-compliance in this respect, the notices are being issued from the system itself, right? And the provisions thereof it. So this is a difficult proposition, but anyways, this is the law as of now, and of course there's a chance to challenge it, but we can't keep on challenging each and every aspect, and this challenges in the court may take a lot of time, because the government is bent upon putting up this system. So it is really going to be a difficult task to challenge it. So what should be done in the meantime? Of course, try to be as compliant as possible with the law. So, and in case if you have missed the bus or are not able to do it, then yes, the matter is worth challenging. But yes, worth challenging not at the assessing officer level. It has to be at the highest level. You need to go to the High Court and maybe to the Supreme Court to challenge these provisions. It is not going to be an easy task during the assessments and audit. None of the officers are going to allow it. Rather, none of them are allowing it at present also. I can share you one more practical example in this, that even in case where refunds are due to the dealer, although the dealer is having a tax invoice, a physical tax invoice which is issued by the seller, but still, if in GSTR 2A those details are not getting auto-populated, the refund thereof is not being issued by the department, and they have issued circulars in this respect not to issue refund to the extent of the mismatches. So this has become a very important task, and in other cases, notices are being issued to the dealer for the mismatches. Then another reason for the GST notice is that the GST refund is wrongly made or is wrongly made with or without the intent to defraud the revenue. So there could be cases where a GST refund has been claimed by the dealer. There could be no intention to defraud the revenue, but there could be a genuine case where the dealer has actually claimed a refund, but the department feels that the refund was erroneously granted. Maybe there was some error in calculation, there was some error in mismatch, and in that case, the department can issue a show cause notice to the dealer that the refund has been erroneously granted, and such cases can also arise. We have seen practically such cases where the refund is granted, and then the department is sending their data for review. Review led to the show cause notice. Show cause notice led to a demand of the refund which was already issued. That further led to an appeal being filed before the additional commissioner that the refund which was claimed by our client, our dealer, was correct, and the calculation by the department is erroneous. And ultimately, we succeeded in getting the refund or getting removed that demand for an erroneous refund claim, which was made by the department subsequently after the refund was issued. So we can understand that there are provisions, and department has already started issuing notices for such cases. Then one of the most common notices which are being received nowadays are the intimation of interest as being payable under section 73(5) or 74(5) of the CGST Act. While filing the return, there is a tab that you need to pay the taxes. Only if your taxes are paid, the returns get filed. But there is no specific limitation that if the taxes are paid late, then interest also should be paid. Then only the return can be filed. So what people were doing, okay, they have paid the taxes late, but they have paid it based on the payment of taxes. They have filed the return, but the interest thereof they have not paid. And some of the officers of the department did a survey and found out that interest worth rupees 40,000 crore was paid or was not paid to the department. And then a spate of notices started being issued by the department for recovery of interest in various cases. Of course, there is a different twist in this tale also, and that is that in the case, in many cases, the notices were being issued for even in those cases where tax was paid, but tax was paid on the net cash payment which was made by the dealer. What is the net cash payment is? Say there's a liability on outward supply of 100 rupees. There's an input tax credit of 60 rupees. and balance 40 rupees is required to be paid by the dealer, which the dealer has paid. That 40 rupees was required to be paid, say, by 20th of April, but the dealer has, say, paid it on 20th of June. So he is late by 2 months. So there came up cases that interest should be payable on this amount. But whether the interest should be payable on 40 rupees or 100 rupees, that was the matter. In one of the judgments which came before the Chennai High Court, the High Court said that as per the provisions existing under the GST law, it should be paid on 100 rupees. And thereafter, for all cases, interest was being demanded on the gross tax liability and not on the net tax liability. Thereafter, in the previous year, an amendment was brought about in the CGST Act. Section 51 amendment was brought about, and the government also came out with a circular. And in this budget, they have made this amendment retrospective, or they have proposed to make this amendment retrospective, which of course the circular also mentioned that in such cases where the interest is being charged, it should be on net cash liability and not on the gross tax liability of the dealer. But still, various notices are being issued. We need to check that whether the notice is on the gross amount or net amount before making any payment towards this. Of course, there will be different notices which are mismatch in the e-way bill data with the GST returns. Mismatch of GST TDS data with GST. These are the new notices which have started recently. Mismatch of GST TDS data with the GST returns. GST TDS is applicable as of now in very few cases. Basically, it is more so where the contracts are with the government. And as we know, all this TDS which is deducted by the government comes in late. It did not come on time. So say at the time of filing of a return, say for the month of April, say for the March 2021, the person might be knowing that there is a TDS credit which is available, but the TDS challan payment for that, say, is made by the other person who is liable to deduct TDS, say in the month of May 2021. Then thereafter the recipient.
हेलो दोस्तों, अटलांटा से डॉक्टर राकेश शाह बोल रहा हूँ। आज एक बहुत ही इंटरेस्टिंग क्वेश्चन मुझसे पूछा गया कि वैक्सीन लेने के कितने दिन बाद दारू पीना चालू कर सकते हैं।
हेलो,
मैं तो पीता नहीं, इसलिए मुझे ज्यादा सोचने की जरूरत
महेश। Yeah, sorry. Yeah.
That question was also interesting.
Agreed.
Okay, so yeah, I think we have. I think we'll just have 5 more minutes before concluding this slide. So GST TDS data that gets reflected maybe in the month of May, that challan payment is made by the person who is deducting the TDS. Then there is one more procedure, which is again not an automated procedure, wherein the recipient will have to go to the portal and accept this TDS credit. And then that TDS credit goes and falls into the electronic cash ledger. It is not like our 26 AH automatic 26 AS mein wo credit aa gaya. The person will have to go to the portal and accept that TDS credit which is available to him, and that will go and lie in the TDS in the electronic cash ledger. Then at the time of filing of the GSTR 3B returns, that credit which is lying in the electronic cash ledger can be utilized by the person who has provided that service or that supply. Right. So this is how the process is, and there is always going to be a mismatch in every case of GST TDS credit. I don't know why the government is at the first instance issuing notice for this TDS credit, because this TDS credit does not get reflected directly in the 3B returns, first of all. Second, every time the TDS data is going to, the TDS challan payment will be at a later stage. It will not fall back to the respective period to which that credit is given. There is no mechanism as such. And every case, 100% of the cases, there are going to be mismatches. Then why is the department issuing notice? They should not issue such notices. It is not required to issue notice because there will be no matching at all. Yeah, of course, department can only get an assurance by asking the question, is that okay, say for a credit of say 1 lakh rupees which is received in June, when was the respective sales reported in GST or 3B? And there maybe they may able to identify that, okay, a particular person has not reflected that particular data in his GSTR returns. And that could be one purpose. Otherwise, this is never going to match only. Of course, the next is conduct of the audit by tax authorities leading to a show cause notice. I'm not taking up those issues. I already mentioned it earlier. And where a business is liable but has failed to obtain the registration and not discharge the tax and other liabilities under the GST Act. There also a notice can be issued that you have failed to obtain a registration, you need to take up registration. So these are the various reasons for issuing a note, for reasons for notices. And of course, once the data, once that show cause notice has been issued or once an audit has been taken, the detailed the details of that client, of that SSE, that registered dealer, will be checked by the department. In that, if there is any data mismatch or there are any other irregularities between the books of accounts and the returns filed, that will be a separate assessment or an audit which would take place, which would lead to a show cause notice and thereby submissions thereof. Well, these are the main reasons for the notices which will lead to assessments. This is the format of a notice for that interest part which I was mentioning. I'll not go through that. Well, there are other slides. I'm just glancing through them regarding self-assessment. What do you mean by self-assessment? Which are the forms thereof? What do you mean by provisional assessment? Provisional assessment, as I mentioned earlier, where a registered person is unable to determine the value and or the rate of tax. So provisional assessment can be requested by the dealer only where he is unable to determine the value. Say he is supplying certain goods and is unable to determine the value of those goods. Well, this does not come in the normal scenario of a trader of goods or a provision of service. This comes where certain valuations or deemed values are required to be determined under the GST law. In those cases, only such cases will come. And where the person is unable to determine the rate of tax. Now, there could be classification issues in rate of tax. That whether the rate of 5% should apply, 12%, 18%, or 28% should apply. There I understand there are various ambiguities which are there in the law. Again, this law is again the taxes thereof under which are to be paid are to be linked to the HSN code or the service accounting code, that is the SAC code also. I would like the members to know, to get updated, that this HSN code and SSE code are being made mandatory for all with effect from 1st April 2021. So we really need to take care of, because government then based on those HSN codes will issue further notices that there's a mismatch. Your item is actually say item A and the HSN code thereof is say this particular code and the rate thereof should be 18%, but you have applied 12%. And that is what is going to be the next spate of notices which are expected from the department. Classification issues. Of course, the process flow of provisional assessment is there. One more point I just wanted to mention was just for information of everybody in the update part of this is that e-invoicing had already become mandatory for companies earlier with turnover more than 500 crore. Then it was made applicable to companies with turnover more than 100 crore. And now from 1st of April, this is going to become mandatory for companies with turnover more than 50 crore rupees. So every company who's having turnover more than 50 crore in any of the preceding financial year from 17-18 onwards will have to issue a e-invoice for all their B2B transactions, exports, SEZ transactions, that is supplies to SEZs and deemed exports, for all the types of documents such as the tax invoice, debit note, and credit notes. So all this will be under e-invoicing for all companies having turnover exceeding 50 crore from 1st April 2021. Yeah, this is regarding the HSN code which I was mentioning. Now the new rule will be that where the turnover is up to rupees 5 crore in the preceding financial year, 4-digit HSN is mandatory for all B2B invoices and optional for B2C tax invoices on the supplies of goods or services, right? So if it is a B2B transactions and the turnover of the dealer is less than 5 crores, 4-digit is mandatory. If the turnover is more than 5 crores, 6-digit is mandatory for all, for B2B as well as for B2C transactions. The government has also come out with new functionality to search the HSN code. It is available on the website. Without login, you can go and check what is the HSN available. Of course, the GST audit due date is 28th. Has been extended from 28th February to 31st March 21. So those whose GST audits are pending, kindly get them completed before 31st of March. And just the disclaimer. And in case if there are any questions, we can take up a few of them. I already exceeded 10 minutes of my allotted time.
No worries on that. Thanks, Pranav. That was really a nice presentation, and hope you keep coming to this forum and speak on lot of more knowledge, share a lot of more knowledge with us.
Sure. Whenever time permits, we will definitely try to join.
Do we have any questions for Pranav? We'll welcome that. Okay. Thanks, Pranav, for your time. Yeah.
Thank you very much. Thanks, Aditya. Thanks, Manoj ji.
Thank you. So now we have Sandeep Raichuria. He is CEO and at Prabhudas, Lilladher, and he is and I'm Bangalore. Hi, Sandeep.
Hi, good morning, everyone.
Yeah, I just hand it over to you, and yeah.
Sure. You can see my screen, Aditya?
No, I'm not. Like it says, yeah, now we can see that. Yeah, perfect. So
perfect. Thank you so much for having me here today. Thanks to all of you, and it's an honor to be among some very distinguished gentlemen. Thank you, Manoj bhai, for insisting that I join this session. I think the first session itself seems to reflect how in-depth the think tank is in terms of the topics that it approaches. Unfortunately, like Pranavji, I'll be delving with something which is far less difficult and possibly, much more, instead of giving money to somebody, we are talking about how to extract money from somebody. So I hope that I get to sort of attract you to do what I am saying. And at the same time, the topic that actually I wanted to name it as was that, derivatives are actually a very interesting area. And the way we approach it as investors sometimes leaves us all in a mess, irrespective of market conditions. And the entire perspective that I'm trying to present in this presentation is that derivatives, if used properly, can be a great tool for enhancing returns. So I beg you to be patient with me for about 25 minutes. I think that's all it's going to take. Thank you again to the Think Tank series. This is the disclaimer that I've been asked to present. The views are my personal views. These do not represent the views of Think Tank or the organization either. Very briefly, I think Aditya did mention this. I head the non-institutional business Prabhudas Lilladher and basically a postgrad from Delhi School and EEP from IMB. Thanks again, Think Tank, for having me here. Like I said, I think over the past 25 odd years that I've been in capital markets, I think I've learned the following things, and these seem contrary to what we seem to believe as traders or investors in the market. I believe that markets are scary. They're of course very wild and violent, but these can be tamed. And if you wish to tame markets, you essentially you essentially need to believe in certain principles. And I've come to believe in 4 or 5 things that I think can help you tame or understand at least market movements much better than possibly you might have done earlier. And as I go along the presentation, I hope that some of these things become clearer. So my 4 or 5 beliefs are very clear about markets. One is that you don't have to sort of outguess markets. Markets do tell you what they will attempt to do, as long as you're listening carefully to what is happening. You do not have to try and outsmart the markets. They leave enough footprints in the sand for you to follow. But in our, hurry to be first in the market, I think we often end up making a lot of mistakes. I tend to believe that we should avoid that and listen carefully to what the markets are telling us. I also believe that price, Reliance 2,000 ka ho jayega and 2,500 ka ho jayega kind of statements is what leads us to make errors in the markets, because Reliance is a stock, Hindustan Lever is a stock, ITC is a stock. Stocks are always subject to factors impacting overall market conditions or their sectors or themselves, right? So how do you remove all this noise and focus on the stock? If you can figure that out, I think there's a great lot of money to be made in capital markets. One more thing I've learned is that, and I've learned this over the years, is that stocks which are very, very similar in their output and in their raw material mix, irrespective of what sector they belong to. And this is very, very true about, sectors like metals and cement and banking and so on and so forth. As long as they have a similar chemical makeup in their output and input matrices, I mean, minus the small little aberrations about which markets they serve and profit margins and brand identity, etc., they would tend to travel together. So just to give you an example of what I mean, if you came to me and asked me कि Hindalco का भाव कितना हो जाएगा, my typical question would be कि आपको क्या लगता है कि वेदांता का भाव कितना हो जाएगा? Then I'll tell you the Hindalco price, right? And I'll explain to you a little later why I said what I said. So I think birds of a feather, meaning stocks in the same sector with a similar chemical makeup, will always tend to move together. And that is a fact. And I've been seeing this at a personal level for almost 12, 13 years now. And finally, derivatives are a two-edged instrument. But if you use these instruments to your advantage, I think derivatives can substantially expand your returns and do this very, very safely. So I know that the word derivatives and the word safe should not go together. It's sounding absolutely silly or ironical, but then that's the way it is. And I'll show you what I mean by that. And most importantly, all of us are busy with our lives. So what if we had a situation where you could sort of follow markets, make money safely, and not have to spend, reviewing your portfolio statements every second day? So what if you could have a particular way of trading in which all of this can be combined? Now, I'm not sure how much weight or credence you'll give to what I just said, but imagine if I were right and these 4 or 5 factors were available in a simple way for you to understand and interpret markets or even trade markets. I would believe most of you would sort of be very excited about this fact. I'm sure some of these things do not sound very intuitive, but then actually they are true. And I'll try and spend the next 10 minutes trying to show you what I'm saying. So derivatives, we obviously know that, it's a two-edged sword, I mean, I've seen, hundreds of people lose their entire capital, they were long on the markets went up, and yet they lost all their money. They were short on markets went down, and yet they lost all their money, So things like that I call the ugly way of managing trades, where you panic for no reason at all. You don't have a strategy, or you don't have stop losses, or you're not watching markets carefully. Then there is a bad way where you do certain things right, but then, get a lot of other things wrong. Maybe you got your market direction right. Just when you were about to, square off the trade, markets went down, or you were, sort of at the very, very pit of a stock. I mean, kal mere ko example there is, for example, Axis Bank available at 350 and 400 rupees. It was a no-brainer. And, just when it turns, you are forced to sell off your position. You got your strategy right, but then the price levels were wrong. So, and then there is a good way. I mean, there are algorithmic traders who follow tight discipline. And then there are traders like us who may not use algorithms, but we use pure common sense and possibly may get it right. We have a strategy, we have stop losses, we know what we want, right? So derivatives is about how you deploy the tool. It's not so much about the tool itself. So the first 3 things about the topic that I have on hand today is, how do you, we all know markets are cyclical, right? Markets upar jate hain, markets niche jate hain, markets flat rehte hain. But then when you look at market levels, let's say for example Nifty, you would be scared. You know that it's trending up. But then if you don't have a benchmark, we use benchmarks in our lives, right? Ladka kitna lamba hai, so we use a scale, right? Shirt kitni badi hai, we use. So we always use benchmarks for everything we do except in stock markets. In stock markets, we don't use benchmarks. We look at prices themselves, which sounds very, counterintuitive. We know that markets are cyclical. लेकिन जब हम 7,500 देखते हैं and then 15,000 देखते हैं Nifty, we get confused. But imagine, instead of seeing Nifty by itself, suppose I showed you Nifty like this. Now, just to explain to you, this is a chart which shows you, this is just an example to show you cyclicality with a benchmark. I divided the price of Nifty by the price of the bank Nifty. Hello? Hello, Aditya, am I audible?
Yes, you're audible. Sandeep,
You are
would
audible.
would you like to start your video?
Yeah, sure. There seems to be some background noise.
Yeah, there was. I have done the.
Okay, one second. Oops. 1 second. How do I? Yeah.
Perfect.
All right. I'll go back to screen share.
Yeah.
Perfect. All right. So if you applied a benchmark, for example, I divided the price of Nifty by the bank Nifty. Now, if you see this chart very, very carefully, you see that it has a wavy structure. Meaning, forget about the levels, etc. Don't worry about where the markets were and what the numbers are, etc. Just look at the wavy structure on the screen below. Now you'll see that there is a cyclical movement of the market and it's tending to move in waves, right? Now don't worry about how to read these waves, etc. because those are all very separate, topics of discussion. But the question here is, if you had seen the same chart of the Nifty on a, absolute price basis, you would have seen some wild, jagged movements. But the minute you apply a benchmark, it could have been any benchmark. I just divided it by bank Nifty just to sort of make a scale. You'll see that it acquires a very wavy structure. Once you convert markets to a wavy structure, what I call relative momentum, they become much easier to understand because as you see, there are these, greens and reds which are tending to fluctuate. Now, this is the thing about cyclicality. How do you convert cyclicality or seasonality into something which is easy to understand and interpret? So this is one way. So this is called relative momentum where I'll give you an example. Let's say you were looking at the price of, let's say, Hindalco. If you, instead of looking at the actual price of Hindalco, you divided the price of Hindalco by an index, let's say the CNX metals index, right? You would actually get the relative pricing of Hindalco vis-a-vis its index and actually be able to capture relative momentum 80% of the time. So if somebody asked you a question, कौन सा stock लेना चाहिए? Don't look at the Hindalco chart, look at the chart of Hindalco versus its own index and you'll get a clearer answer. Now the second question, markets are cyclical, but within cyclical markets, how do you go about, creating trades? So in that, there are two concepts which I find very, very appealing. So something called correlation and something called mean reversion. Now, what is correlation? So correlation is essentially, stocks from a sector, like I said, with a similar, raw material and an output matrix would tend to behave very similarly. Now, you may not believe this, and I've been, I've been personally very, very passionately involved in doing all this. I've been doing it mathematically, and obviously we are not allowed to trade, so I can't put in 90% of what I actually would recommend. But if you looked at the prices of stocks like an Ultratech or an ACC or an Ambuja, for example, in the cement sector, you will see that they tend to travel very, very similarly. Okay, with a gap of maybe about 2 or 3 months. Where stock A goes, stock B will follow. Similar is the case with banking. Similar is the case with metals. Similar is the case with oil and gas, and so on and so forth. Now, all of these stocks may not have similar behaviors because obviously, like for example in cement, having a monopolistic share in a market which is growing very rapidly would be very different from a company which is possibly selling cement all across the country. This would be a slower stock, right? So you've got to take those things. But however, the fact of the matter is the cement sector would tend to move together. That's essentially called correlation. Now, how do you measure correlation? It's a mathematical concept. where you look at how many times when stock A's price goes up, stock B also goes up and vice versa. This is called correlation. So it's very essential for you to try and understand if you are going to shortlist a trade, or any particular stock based on relative momentum, does it have correlation to the other thing that you're comparing it with? That's called correlation. The other thing is called mean reversion. So, what goes up will come down wala jo theory hai. Essentially, markets tend to, fluctuate between greed and fear, and therefore you will often see cyclical behavior where prices will tend to overshoot and then undershoot what is called an equilibrium price. So, let's say we believe that this is the theory, and the reason I put the Amitabh Bachchan picture here is because, if you've seen this movie, both the brothers, leave the bar or the boxing ring together, get very, very drunk. And because they are drunk and impacted differently by the situation, for a little while on the road while they are singing this song, Chal Chal Mere Bhai, they tend to keep moving on two opposite sides of the road. But I think Nirupa Roy was the mother. By the time that they reach home, they both converged, right? They both come back home, irrespective of how much they were drunk and how much they were moving on both sides of the road. That's essentially called mean reversion. That at the end of the day, two correlated stocks will always come to their mean. Now, these are two very, very essential concepts. Now, the question is, where do you draw the boundaries? Chal Chal Mere Bhai mein, the end of the road is a boundary. So, in our charting tools, when we do all this, the boundary is drawn by something called the Bollinger Band. Now, the Bollinger Band, I'll possibly show you an example because I forgot to put an example here, and it's not necessary. Broadly, you need a boundary, and I'll show you how to do that. The third key way in which you can make money, assuming that you've simplified cyclicality of markets, assuming you've understood correlation, and assuming you've understood mean reversion, and now the final challenge is somehow if you could remove the impact of markets. Let's say, aaj aapne ek stock kharida ya becha, and tomorrow morning the markets open up 20% or open down 20%. I'm sure you're going to have a sleepless night, right? If you're on the wrong side of the trade. Now imagine there could be a way of removing the sleeplessness by not even caring how markets will open tomorrow or how markets will do for the next 1 year. And that's essentially the third part. Now, how do you do that? So I'll give you an example of what I call pairs trading. Let's assume that ACC and Ambuja are two stocks which are like, Amitabh Bachchan and Rishi Kapoor, very, very closely related. They often tend to display what is called mean reversion behavior, highly correlated stocks. Now, imagine that I went long on ACC. This is just an example. This is not an actual trade. If I went long on ACC, one lot of ACC is worth about 8.5 lakh rupees. And I went short on Ambuja. Again, the value of an Ambuja lot would be around 8.5 lakh rupees. So you're long 8.5 lakh in markets, you're short 8.5 lakh in markets. So the minute you've done that, what you've essentially done is remove the influence of markets, which means kal market upar khulega 10%, niche khulega 10%, sare cement ke stocks 10% upar khulte hain, niche khulte hain, it's irrelevant because you're long and short on the same sector. So you removed the sectoral impact and you removed the market impact. Now, typically, now I've mentioned something called correlation here, 88%. This is actually true. If you look at data of prices, daily prices of ACC and Ambuja over the last 10 odd years, you will find that the daily price movements are in the same direction 88% of the time, which means jis din Ambuja upar rehta hai, ACC upar jata hai, and vice versa. When Ambuja is down or ACC is down, the other one follows him down or her down. That's called correlation. So essentially, what are you doing? You're basically throwing the market out of the equation. Now, the ACC Ambuja example that I gave, let's say tomorrow markets, open up. Both the stocks are up 5%. You will maybe not make any money because you're making 5% on one short stock and losing 5% on the other stock. Same way markets go down, it doesn't matter because you're going to not make any money. So when do you make money? You make money when the stock that you are long on, in this case, let's say ACC, outperforms the stock that you are short on. It doesn't matter how the outperformance comes. So just to give you an example, let's say ACC, tomorrow markets are up, ACC rises 5% and Ambuja rises 3%, still you will make a 2% profit. Let's say tomorrow markets are extremely poor. Markets open down, I don't know, 1,000 points. ACC falls 5%, you lose 5%. But Ambuja, where you're short, falls 7%. You still make your 2%, right? So the entire point behind the trade is, can the stock that I'm long on outperform the stock that I'm short on? That's all you're looking at. You don't care about markets anymore. You've actually removed the markets from the picture altogether. Now, what we do professionally or personally is that we put all of the stuff that I just said on simple charts. So, for example, this chart shows you, if you look at the chart carefully, it shows you, for example, we have picked up HDFC and HDFC Bank as two stocks where I'm long on HDFC and short on HDFC Bank. I am looking at this boundary is called the Bollinger Band. This is just a frame for reference. There is no God-given formula on this. It's just that it tells you when there are extremes being reached. And in markets, there are various measures for measuring what is called extremes. It's like an elastic band. आप elastic को कितना खींचोगे before the elastic sort of snaps back, right? So the Bollinger Band is essentially measuring the elasticity of the price moves, and then it gives you buy and sell signals based on our formulas. It tells you that ये बहुत हो गया. HDFC has underperformed very, very badly, and now is beginning to move up. The minute it moves within the road is defined by the Bollinger Band. It is time to buy. So you see, I mean, you may not get it exactly right, but broadly, if you sold here, you would have booked profit here. You would have bought here. You would have, sold here. There's no trade here. You would have bought here. You would have made all this money, and so on and so forth. So you, in the same trade, by going long and going short on two pairs of stocks for the entire year, you manage to be sometimes long HDFC, short HDFC Bank, sometimes the opposite. And in 1 year, you had almost 6-7 trades. All you had to do was just listen to the markets carefully and see which way the trade is moving. And there is some basic formulas involved here, but then, we can always talk about it at a later stage. But broadly, the correlation was at 88%. The stocks were moving within boundaries. From outside the boundary, they started moving back in. So which means what we call mean reversion started, and the stocks were similarly sized. Right? So essentially all the three principles that I talked about, it should not have any market influence. It should be similar size stocks. There should be high correlation, and there should be a frame of reference so that we know that it is moving towards what is called mean reversion. मतलब ये बीच का footpath. This line is very, very important. This is how we track pairs. Just to give you an example, like I was talking about the metals index, you don't need to track stock A versus stock B. I do this very much. This is actually a favorite chart of mine, where if you ask me how are markets looking, one of the indicators for me is how HDFC Bank is doing versus the bank Nifty. Now, just to show to you what I mean, I've taken the chart from when the COVID situation started. Okay, so this is last year, COVID beginning on the left side, and this is current. Every time HDFC, because intuitively we know, right, HDFC Bank is heavily FII owned, it is a very defensive stock, markets टूटता है तो लोग HDFC Bank में, all of this intuitively we know. But then उस intuition का करना क्या, unless we convert it to some kind of an input, right? So I convert it to an input like this. As long as I see HDFC Bank trending up vis-a-vis Bank Nifty, on this side, I have actually not taken the HDFC Bank price, I have divided HDFC Bank's price by the Bank Nifty. As long as HDFC Bank shows me an upward trend, it means that the Bank Nifty will remain weak because HDFC Bank is outperforming. A defensive stock outperforming means the underlying market momentum is extremely weak. And last year, around September, October, suddenly HDFC Bank started to underperform. Yahan pe Bank Nifty was around 27,000, 28,000 levels. Nifty was already beginning to do well, but Bank Nifty was not following. And I remember TV पे सब बोलते थे कि बस banks तो चलेगा नहीं, और हम लोग बोल रहे थे banks यहाँ से कम 1.5 गुना चलेंगे. And we told people to buy Axis and IndusInd and SBI, and we went very heavily on banks. Now, one of the behaviors was that September, October of 2020, suddenly HDFC Bank started to underperform the banking sector, and it is still doing that. So as long as it continues to display this behavior, to me, it clearly means that the underlying Bank Nifty will remain strong. So this is one way in which I read relative momentum. to reach views on markets. And this is the other way where we can actually trade and make money in markets. So relative momentum is a very, very useful tool. This is one of my favorite trades. I don't want to delve into it too much. I've just taken 1 year of charting history. This is ACC divided by Ambuja. And this pair I've been tracking since 2008, I think. When Ambuja was 900 rupees, ACC was 900 rupees and Ambuja used to be 700. Right now, Ambuja is wherever 290 के आसपास and ACC is double the price. Irrespective of what has happened, आप देखिए भाव ऊपर नीचे हुए हैं, markets गिरे. But the relationship between these two stocks, I have divided ACC's price by Ambuja's price. If you see, it is like a calm chart over the, this is only a 1 year chart, but if I drew this backwards to 10 years, you will see that the price of ACC divided by price of Ambuja always fluctuates between only 6 times and 7 times. Even if you trained a 15-year-old kid to trade this chart and track only 2 stocks in the equity markets, I'm sure you could be a crorepati by now. So, in a sense, what are we using? We're using, like I said, correlation, which is very, very important. Something called a look back period, meaning that whatever I'm assuming about what's going to happen, has it been happening in the past? So for trades, we use 60 days, but for actual studies, we go back to as much as 5 years. We use fundamental filters, meaning that, is there structurally something similar or different about the 2 stocks? Would I be making a mistake if I took a position? Because a stock which is outperforming may continue to outperform forever. So there's a risk in that. So we look at fundamental filters. We also look at only liquid stocks, typically when creating such trades. Like I said, Z-score is nothing, don't get worried about Z-score. Z-score is nothing but a mathematical formulation for the Bollinger Band, where I know ki elastic ki boundaries kidhar hai. And typically, if you do this kind of a trade, if you've done it well, you really don't need to worry about what's happening to markets. You can easily, get into the trade and go abroad for a trip and come back after 3 months. Worst case, you would possibly be still standing there. So this removes the entire stress of markets, despite you using derivatives and despite us being at 15,000 levels and so forth. At Prabhudas Lilladher, we've also added certain additional criteria over the last 1 year to now make this what I would consider a fairly safe and simple trade. So if you build all of these building blocks, I would consider these an awesome combination. And just to show you an example, we've been sort of refining our theory. So when we started doing these trades early on a margin of, we started with 10 lakhs. And the idea was to do just 1 or 2 or 3 trades in a month, except once in a while. We used to make mistakes, right? So if you see here, there are some of these trades are profitable and some of these trades are loss making and so on and so forth. Over a period of time, however, we learned with that secret sauce that we added. If you see from last year, virtually we've had no trade. We've done, I think, 9, 12, roughly about 30, 35 trades, and virtually only 3 or 4 trades we had to stop loss. And in the last 9 months, we've actually had no loss trade. So we've improved this over a period of time. Our target return on this very, very easy trade, we just give 1 or 2 trades a month because we don't want customers to, trades can be done for 1 month, 6 months, 2 years, 5 years, and so on and so forth. I don't know, but many of you may not know that Morgan Stanley started pairs trading in 1986, and the entire corpus of Harvard's education grant as well as MIT was actually managed substantially by Morgan Stanley using only pair trades. So we've also created a very simple trade where we sort of target only about a 15 to 20% per annum kind of return for customers. And over a period of time, as we have done this, we've realized how you can completely remove losses, completely remove market failures, etc. from such a simple trade. And on top of that, not having to pay brokerage and transaction taxes and so on. Plus, you don't need to invest, right? In derivatives markets, you can just park your stocks. So imagine if we can generate, badi aram se 15-20% per annum kind of returns with just 2 or 3 trades a month. So does it work? Yes, it works. It works beautifully if you do this well. Just for the heck of it, for those of you who are interested, I've deliberately brought back this trade now. This is, I think, yesterday evening's chart or maybe yesterday morning, but I think broadly nothing would have changed. Right now, this chart says that after having substantially underperformed in the last, I think, 3 months, right from the beginning of January, HDFC Limited is beginning to show the first signs of beginning to outperform HDFC Bank, right? And the cyclicality factor below shows that the blue line, I am not getting into the mathematics of this entire thing, but broadly the convergence has started. That this entire convergence toward HDFC Bank again rising vis-a-vis HDFC rising vis-a-vis HDFC Bank has started. So I may not recommend this trade. I'm in no position to recommend the trade. However, it would be nice if some of you are interested, note down the prices as of yesterday evening for HDFC and HDFC Bank and see over the next 1 to 2 months what happens to the price difference. Meaning, if HDFC is ahead by 1,000 rupees right now, does it increase as per this chart, what it is projecting, or does it decrease? If it increases, it means you made money. If it decreases, it means you lost money. Of course, there are risks involved in this kind of trading. While I talked about Morgan Stanley doing so phenomenally well for Harvard and MIT, at the same time, we have an example of long-term capital management. Jab main D school se nikla tha, I remember going to their offices in Connaught Place in Delhi for a job. Layman and long-term and all of these people were like gods of markets at that point in time. They also, by the way, were paid traders and they collapsed, right? Because they got one of their trades very, very wrong in 1997 on Asian currencies. So, right, so you obviously have risks in pairs trading. Timing is extremely important. You need to be very clear about mean reversion and things like that, and ensure that you're not getting into something which is permanently going to diverge, right? Convergence is very, very important. So if you've got your mathematics right, if you've got your timing right, I consider derivatives to be an extremely safe instrument if you use concepts like relative momentum and pairs trading. So that was just the little bit of value that I wanted to add to our people who may know this. I'm sorry if I wasted your time. People who didn't know this, maybe a couple of things more to chew upon. That's all from my side. Thank you so much. If there are any questions, I'd love to take. Yeah, Aditya, I'm through. Hello, Aditya? Yeah, I'm through.
Sandeep?
Yes.
A quick question. In that historical data that you showed on performance,
yes.
February and March 20 were missing. So what was the experience there?
1 second. February, no.
And March 20.
Yeah, there wouldn't have
February,
been any.
March 20.
We wouldn't have done any trades then. They were.
How is it? You would not have known that the fall was going to happen.
No, we wouldn't have. No, nothing to do with COVID. I wouldn't be bothered about COVID or markets collapsing, etc. But I think what would have happened is that, we had suspended all our algorithms at Prabhudas Lilladher. All our algorithms were suspended after February 15th because of some regulatory changes, nothing to do with COVID and markets fall and all that.
Hi, morning everyone. Dushyant Shah here.
Yes, Mr. Shah.
Yeah, Nipun. Hi. Since you are now with us, can you also throw some light on this derivative research?
So, of course, this is old stuff. I think in India, probably pair trading was started sometime way back in 2003-4 or thereabouts. I remember Edelweiss was doing it very actively.
Yes, 2006 onwards, yes.
So it has evolved over time based on experiences of price movements and it gradually evolving. Of course, globally, it's a very old strategy that's used. I think what's important probably, Sandeep, is to throw a little bit of light on what's the percentage of success that one has on pair trading. Because what had come out while observing experience at some of the other brokerage houses was that broadly there's a 55% success ratio that's there.
Correct.
That the right percentage, or is there a higher success percentage that's there? Correct.
So no, I completely agree with you. So I myself, right from 2011 to, if you ask me honestly, till about 2016, 17, when we looked at pairs, broadly, I would not call it 55%, but my own experience with because I've been passionate, so what I did wherever I went, I ensured that there was a desk constantly researching pairs. The percentage never went beyond 65-70%, right? And between 2016 and 2018, even in very sharply uptrending markets and downtrending markets, the ratio didn't improve or didn't worsen. But then, just to tell you very honestly, see, there are two ways in which you do pair trades, right? There is the quant way of looking at, so what I didn't mention is certain other statistics like, so there's something called co-integration, right? So you look at the stationarity of the mean and stuff like that, which is purely mathematical in nature. If you apply things like, those kinds of filters, and there are lots of mathematical filters to all of these things, you tend to become overly bogged down by the mathematics of it rather than focusing on the common sense of it, right? And there I realized that, and we've got some algo firms working with us, and in fact, yesterday we had a session with a guy who was doing it for an insurance company abroad for pairs. So when you look at day-end data and you look at mathematics, the best guys are not able to exceed 70-75% success. But then that 70-75% is actually a very good return. What I did last year, we have an algo desk at Prabhudas. What I did was I told them to slow down the frequency, meaning I don't need to do a trade every second day, right? Which is what, the system actually keeps throwing up. I told them to slow down the entire thing, and we applied certain technical filters. I won't get into what those technical filters are, but I can only tell you that those are absolutely silly technical filters, which a first year postgrad who's doing technical analysis would know. And you won't believe that while if I got, let's say, about 40-45 trades in a month earlier, if I consider only day-end trades, those trades slowed down to about 6 or 7 a month. But those 6 or 7 trades in a month gave me a 95% accuracy rate. What we've done is, within those 6-7 itself, if the correlation is not extremely high, and we also supplanted with fundamentals, earnings growth and price momentum, earnings momentum and all that, I select only 2 or 3 trades in a month. So the data that I showed you over the last 6-7 months is a deliberately slowed down strategy where we become hyper about not losing money. We target only 2 or 3 trades in a month, and I realized I have a 100% hit rate. So it depends. So if you're an algo player, there are people who do trades almost every minute. There are people who do trades every hour. There are people who do long-term trades, things like index versus index, go long China and short India and stuff like that. So we've realized that with Indian investors, especially, the HNIs, we don't need to outsmart markets and we don't need to do all kinds of stuff. A 10 to 20% kind of additional dividend through pairs on stock margin is fairly good. So stay within highly correlated entities. Now, correlation comes from where? Correlation comes because wholesale is common between ACC and Ambuja. HDFC is common between HDFC and HDFC Bank. So, seek out pairs which offer a high degree of family and industry level comfort. And then the performance improves. Does that sort of answer what you asked?
Yes, I think more or less. I'm sure strategies are evolving now. In order to ensure that the success ratio is a little more than what it was historically. The other thing you could highlight upon for the benefit of a lot of these participants is you mentioned that you could write on the strategy for a month, 2 months, or longer as well.
Yes.
So for the benefit of some of these guys, you can always, of course, highlight whether you would you, if the price movement is in your favor, would you square it up intraday also, or what, or in a matter of a week or 10 days or what? So it's not necessary that you need to hold on to that position for as long as you. So maybe your experience on that is on how frequently can you square up really will help.
Okay, so I'll possibly answer it in a different way. So now let's say this is the let me take a particular. So let's say I entered the trade here, right? Now, if let's say that the trade give me almost a movement of about, this would be about 7 to 8% on a 8 lakh rupee. This is a 50,000 rupee movement, right? Now, if I had waited for this movement to come to this mean, it's possible that I may never have reached here and then finally gone back into a loss. So what we advise our traders is that the minute you get a 2 to 3% kind of a return on your margin. So for example, on HDFC Bank's trades, typically 8.5 lakh rupee kind of thing. If you make about 17,000 to 20,000, just exit the trade, especially if the underlying market is very volatile. You don't have to keep waiting for this entire moment to play out, because what if this happened? Now here, if you entered a short, you were lucky you got the sudden thing, right? Now, if you did not book out, in this case, you were lucky because it continued to move in your favor. But this trade moved only for 3 days. So what we have done is, according to the theory of pair trading, you should wait till the trade reverts from its external boundary to the mean. We are keeping a profit booking target at 2.5 to 3% per trade, because we know that we are again going to get an opportunity. So if my trend is down, and let's say I booked here, if this mean breaks, it means that the trend will continue to move down. So I mean, it depends on the customer, but I would tend to say move in and move out of trades, especially if the underlying market is extremely volatile, because everything is cyclical. If you see, there is nothing in this most of the time except this period. You'll get these cyclical movements. So you'll get 10 opportunities in a year once you've understood the mathematics of the underlying trade.
So, Sandeep, to add to what you're saying, I'll probably use one of your charts. If you can,
yes.
One chart in which you showed price movement, a very smooth chart.
This one?
No, not this one. It's just a simple 2 lines that were there. Not a chart, but
are you talking about this?
Something like this. Yeah.
Yes.
The previous one. The previous one.
This one?
No. Yeah, this one. So what I'd like to just, this one. Chal mere bhai wala, yeah. So I think just to add to what you're saying, one must remember that when you have a price movement like this, the line is never so smooth. It's always several ups and down movements that are there, and good traders or algo traders actually take benefit of not just this entire long movement that is there, but there are small movements which happen intraday within a few minutes or within a few hours.
Absolutely.
And that's what is basically algo trading is all about, and that's what benefit of profit taking profits for during pair trading, maybe even intraday in certain cases happens. When you see sharp price movements a lot of times for a lot of stocks, you are actually seeing a lot of algo traders taking benefit of the small price movement.
Oh, yes.
During a day, you might have Ultratech, which has moved from 6,700 to 6,900. But there will be several movements of 67 to 68 to 6,750 to 6,850 to 6,800 back. So all of those benefits are really taken benefit of by a lot of algo traders when they're doing pair trading.
Absolutely. So it depends on so this was more about explaining the concept, but like you said, I'll give an example of a simple trade. I'm not tracking it for the last 2 years. I had friends who would want some advice and wouldn't know how to manage their money, etc. So I used to give them a very simple trade, and this I did for years. I mean, I asked them to do it, and the results were crazily fantastic. But like I said, I've not done it for the last 1.5 years, so I may not be able to vouch for the results now. But till about 2018, and I'm talking right from 2012 onwards, when the markets open, just see if there's a HDFC Bank and ICICI Bank vis-a-vis the Bank Nifty is what I'm talking about. If So HDFC Bank versus Bank Nifty or ICICI Bank versus Bank Nifty, if the gap at the open 9:15 in the markets is more than 3%, which means, I mean, either way, it could be HDFC Bank is down 3%, Bank Nifty is flat, in any direction, do the opposite trade. So let's say tomorrow morning HDFC Bank opens down 3% and Bank Nifty is flat, right? Now you feel like buying HDFC Bank, but you're scared because it's already 3% down, right? Or you want to go long Bank Nifty, but you're not sure because HDFC Bank kind of a stock is down. So, you tend to get scared and stay away. I used to tell guys that you do the exact opposite. So, which means in this case, 9:15 पे अगर 3% के ऊपर का difference है, go long HDFC Bank and short the Bank Nifty. And then watch the trade around 11:30 and watch the trade around 1 o'clock. By 2 o'clock, get out of the trade, irrespective of what has happened. You won't believe 90% of the time, unless there's a result or there's some news, 90% of the time, you'll get away with a silly 1.5% kind of return every single day. So this was a naive trade. Now, like you said, I've got an algo guy who takes the temperature of his trades every 1 minute, right? Because he uses certain filters which are highly, time sensitive. So there are these extremes, but the essential point is markets are made of fractals, right? You want to see a 1 year view. First, you have to take a monthly view. Within that, you have to take a weekly view. You have to take a daily view. And within that, there are people who take 5-minute views, right? Now, we may not agree. Everybody uses their own style. But I have seen that if you take intraday views, ranging from about an hour to a couple of hours on things which are daily and weekly in nature, you can actually do very well in markets. So, but it depends on your skill set. I'm saying you may not get at 100%. Even if you're at 70%, but you manage your risk return very well, I think you'll make tons of money. This was just a conceptual elaboration of what I'm very passionate about. You could do this in various time frames.
Good presentation, Sandeep, explaining the fundamentals of the concept, really.
Welcome, my pleasure. Entirely. So if that's all, I'll stop sharing. Thank you so much, everyone, for patiently listening.
Thanks, Mayur. And we'll appreciate if you keep coming and sharing your knowledge with us.
Yes.
Thanks so much. Mayur, I hand it over to you.
Good morning, everybody. Am I audible?
Yeah, you are very clear. Yeah.
Wow, Sandeep. So you have actually left me at a very, very complex situation to handle. It's like, coming out, watching Malaika Arora doing Munni Badna movie and going into a Ghulam Ali ghazal, which I'm going to present. So it's going to be all the best to me and the participants, because it's going to be that kind of a drastic change in experience. So let's hope we are able to both do justice over here. Right. Thank you, esteemed members of the Think Tank platform, for having me in this webinar series. I'll just share the screen 1 second. So as you would see from the topic, it's a very, very wide and practically can cover many aspects related to investing, portfolio management, or wealth management. So special thanks to the team and Mr. Manoj Alimchandani ji for giving me a wider space to cover the topics freely. When you have less boundaries, it actually makes your task much tougher. So my talk would essentially cover some very basic principles of money and investing, and then briefly encompass on aspects of asset allocation, financial planning, wealth management, and investors' perspective on risk and return. Also, a couple of months back, I did a presentation on skill set required for portfolio management. I thought for the benefit of all to have few slides on it, and finally I'll conclude with my thoughts on what constitutes a successful investment framework within the PMS. So while it may sound a lot to chew, I've tried to keep it very simple with a basic objective of how investors should look at these areas. And I've also tried to move away from the day-to-day stock market discussion and noise. I'm sure for some of us it will be a healthy change. But as I said, after hearing Sandeep's presentation, you're going to be in for a Gulam Nali experience. So hold on to it. So in case anybody is looking for the next big stock idea from a fund manager, let me apologize at the start. So some disclaimers here before we start. More disclaimers, and I think it's very important that to understand that views and opinions are purely personal, and they neither are opinions of the think tank or the institute or the organization one belongs to. And any kind of discussion on sectors and stocks are purely for illustration and knowledge purposes, and not intended to solicit any recommendation or business out of it. And we sincerely request everybody to do their own due diligence and homework before going through these concepts. So let me set the stage with a very basic principle. I'm sure many of you would have gone through this drill many times of a young man starting at the age of 25. And so this is what he accumulates at the age of 60, 23 lakhs 35,000 at the rate of return of 8%. You can all do the maths in Excel. This is a simple way of doing it, right? By investing in PPF. Obviously, PPF rates are a little lower now, but it gives the concept there. There is a better way. If he's able to earn 14% rate of interest, he ends up making 4x the money, and he earns 78 lakh 30,000 rupees extra. I'm sure by now you would have guessed it. I'm talking about the principle of compounding. We all know about this principle, but how many of us are actually able to practice it in reality? Try and see within your own investments, which is the oldest investment you're carrying. Maybe anything, bond, mutual fund, stocks, real estate, anything. And that should give you a reality check about how one is able to practice compounding. A very evolved investor once told me that, Mayur, it is very easy to get 80% in a stock market, but we all are very hungry to get 90%. Now, in most academics, if we get 80%, we are considered to be sharp and intelligent, aren't we? In stock markets, if you want 80%, you need not be sharp and intelligent. Rather, all you need to do is buy a nifty exchange traded fund and sit for 40 years. And that will beat your inflation post taxes by a mile. I call this as 80% in stock market. And this is despite the disclaimer that we all know that past returns may not sustain in future. But then we all want 90%. And then try to do a lot of fancy stuff. Since my previous speaker has spoken about a lot of strategies which are a little shorter in nature, I'll not dwell more about that, but I'll only say that for many of us, some of the very exotic strategies we end up into gives a satisfaction of giving it a high, to satisfy your own urges. Obviously, Sandeep mentioned a very important point that taken in the right perspective, done in a right manner, and used in a correct perspective. So with all those caveats, I'm saying this. So please understand, I'm not at all suggesting that this is bad. all I'm trying to say is in stock markets, people are not content with achieving 80%. So what is the catch? The catch is, it is a simple, I mentioned it is simple, but it is not easy, right? What is not easy is to practice compounding. It's not easy to hold your urges when your friend or neighbor or colleague nudges you with the best idea you think will be a multi-bagger. And that's where, according to me, compounding goes to the dogs. I think somebody's audio was, if everybody can put it on mute. So let's look at the second basic principle of asset allocation. Many of you would have heard that equity allocation should be equal to your age, or rather 1 minus that age, or some mathematical formula. Again, I think a better way here is to allocate to asset classes based on your needs. Let me give you an water analogy here, right? If my objective is to take Bhat for 1 day, all I need is a bucket full of water. But a municipal corporation cannot solve the same problem by giving buckets every day to every person in the locality. They need to provide for a little longer term and build storage tanks, which will be required in case of emergencies. Further ahead, the same water problem cannot be need to be tackled at the state level by building a dam. Only then they will be able to fulfill the water all year round. It also means that if your need is just a bucket full of water, don't try to build storage tanks and dams where it is not required. So in terms of money, if you need the money in 3 months or a year, which according to me is a shorter period, you need to give liquidity as the most important criteria, and that should be done by investing in the most liquid assets. If you need the money for in a period of 5 years, you only need to protect the money and grow the nominal capital to some extent. However, if you need the money over longer periods, say like for retirement or for your child's education, which may be 8, 10, 20, 15 years away, or marriages or any longer commitments, you need to protect the purchasing power of money, and that can be done through equities. And hence the choice of asset class investing has to be based according to your needs. To me, this is in simple terms asset allocation. Another concept, I'm sure you are well aware of the importance of financial planning. If you want to create wealth or manage wealth, you have to first pass through your own financial plan. I remember doing my first financial plan in 2004, and till date, I review that to some extent on a yearly basis. Hello?
અને આ પ્રોફેશનલ ગ્રુપ છે ને જે મનોજ સીએ નો બહુ મસ્ત છે. આ શું ખાઈ જાઓ? આવો ને.
So, can I request Tushar Dedia to mute himself, please? Thank you.
Thank you. Yeah. So, according to me, financial plan is like Maslow's hierarchy need theory. I'm sure many of us would not, some of us would know, some of us would not have it. So, it's like you achieve one stage of your need and then you move on to the next stage of your need. Similarly, it's in a financial plan, you reach one stage and then your need for money moves to the second stage and so on and so forth. What I think is important is to invest rationally during accumulation phase, which is your earning stage, and so that you can enjoy the distribution phase. Right? Actually, all of these topics can be dealt in much more detail, but given the paucity of time, I have just kept it to one slide and added the crux of it on it. So having looked at the principles of money, asset allocation, financial planning, let us look at the basic principle of investing. This is my all-time favorite. If anybody from my organization is here, they would know this. We end up discussing this at least once a year for sure. Um, and one can spend 3 hours only on this one slide. But don't worry, I'm going to take only 2 or 3 minutes on it. So what is investing as defined by the Grandmaster himself, Benjamin Graham, in his book, The Intelligent Investor? He defines it as an investment operation upon is one which, upon thorough analysis, promises safety of capital. It does not say guarantee, right? It says it promises safety of capital and an adequate return. It does not say high return or higher returns. It says adequate return. Operations not meeting these requirements are speculative. Now, these three aspects of thorough analysis, safety of capital, and adequate return, according to me, are pillars of investing. In today's time, stock investing has come down to taking deliveries for few days or weeks or even months. Surprisingly, you will note here that there is no mention of time period which determines whether the operation you undertook was an investment or speculation. It is rather your approach towards it which is important. It is the thorough homework which actually helps you build the conviction required for investing. Now, intuitively or ironically, we must have all done more homework while buying an automobile, which is a depreciating asset by nature, instead of doing more homework while investing in an appreciating asset like equity. Also important to note is that uh, by speculation, Graham is not suggesting any particular type of trade or nature of operation. It can also mean that buying a stock and holding for 5 years, if one has bought the same without thorough analysis and without understanding its intrinsic value, I will say one is largely speculating rather than truly investing. I have myself, in the shoes of a fund manager and in PMS, have had to deal with situations where we had to sell stock in few quarters instead of few years, either because the hypothesis failed due to some event, or probably we didn't do our homework as well and there was a break in thesis. The only solace at such times we get is we followed a rigorous approach of doing our due diligence and our homework and probably learn from the mistakes which so that we do not so that we reduce these chances next time. There is a lot of debate about value investing and growth investing, so I thought it may be of interest to share a slide on it. So essentially, I'll say there were two phases in investing. One which existed during Benjamin Graham's phase era of 1930s to late 1950s, and the other which Warren Buffett actually improvised along with his partner Charlie Munger post 1970s. Now Warren Buffett, I'm sure, and Charlie Munger, we know that they run Berkshire Hathaway, and one of the legendary investors of our times. For Graham, intrinsic value was more about value sitting on the balance sheet, whether in the form of real assets like factories or buildings, etc., or in the nature of financial assets also, but sitting on the balance sheet like current assets, investments, etc. He did not believe in discounted cash flow methods and future projections. And for him, stock became attractive when the price was at a discount to the value sitting on this balance sheet. He believed returns would accrue as this discount will narrow over time and price catches the value. This is how value investing came to be known. So to summarize, for him, value was value as it stood on the balance sheet, within the balance sheet. Warren Buffett, and a large credit goes to Charlie Munger for this, while being a student of Benjamin Graham, deviated from this form of value investing to investing based on competitive advantages and modes of a business or company. For him, attractiveness of stock was not by elimination of discount to the intrinsic value sitting on balance sheet, but rather the fact that the stock's intrinsic value itself would grow in future. Some call this as growth investing. However, what is common in both? Both involves determining the intrinsic value. The former tries to actually capture the intrinsic value sitting on balance sheet, while the latter believes that intrinsic value itself would grow in future. The difference lies in investors' mindset on how they perceive value. Let me just explain this by sector. And once again, I'll put a disclaimer, is these are not recommendations only, but rather used only for illustration purposes. And please do your due diligence and homework for it. So let's say we all know that some of the old economy sectors like oil and gas and power, they are asset heavy businesses, and a lot of real assets sits on their balance sheet, right? Now, this is just for illustration. I'm not at all concluding that a lot of value may be sitting on those balance sheets today, but broadly we can suggest that today's price may not be actually reflecting all the value which may be sitting on balance sheet. To that extent, this can be a good example, and it is a very filtered ground for value investors. On the other side, we can compare stocks from the paints industry or even large private sector banks. Over last 2 decades, very few times you would have seen them trading at discount to their value sitting on balance sheet. They have been asset light businesses, and the intrinsic value has grown multi times over the last 2 decades, and they have given phenomenal returns to the investors. So I think this is how the two differ to some extent in their approach. Do we want to take any questions here, or shall I proceed?
Mayur, you can proceed. If there are questions, they'll come up on the chat, and or somebody could raise the hand.
Sure, thank you. So let's look at wealth management.
Hello.
Yes, hi.
The key.
Hello, हाँ.
Hello.
Hello, आ रही आवाज? Hello. Hello, आ रही आवाज?
I think somebody's mic is on unmute. Can you please mute it? Thank you. The key in any investing, and more so in wealth management, is actually understanding how investor perceives risk and return. For most of us, it is a linear equation. Higher the risk, higher the return. But let me put you through a different perspective through data. Now, this is a little dated slide, but then I think it drives the point very well. People get fooled by average return, and in doing so, understate the risk in that asset or security. Is my cursor visible?
Yes, Mayur, it's visible.
Yeah. Yes. So let us look at a situation where the average for an average additional return of close to 200 basis point, the investor exposes himself to a possibility of -5% against a liquid fund which does not has necessarily given a negative return, right? Or a money market fund. This reality is not captured in the linear equation, right? And seldom people will show you these kind of reality charts, right? That when you choose the assets or securities within the asset, the risk and return need not necessarily go up in linear fashion. And the risk can be much more than what is hidden within the average returns. However, this return and risk equation looks a little better when you expand the horizon from 1 year to 5-year rolling returns. And you can see here that the average returns are also around 100 basis point or 1% higher, and the risk is also not that much, right? So again, the point here is the time is very important for the investing rather than timing. Let us look at, we wanted to cover the opportunities across disciplines in wealth management. So I've just got a slide here and quickly cover through that. So as you can see, wealth management actually encompasses a lot of aspects, and requires many professionals and I'll say skill sets for it to be successful. It encompasses the need for lawyers, a chartered accountant, a banker, even graduates to actuaries, to seasoned investing professionals, and all are required for that symphony of wealth management to be successful. Now, what I have seen is most wealth management firms may outsource one or more of these based on their core focus. They may retain some activities while they may outsource some of it, right? So wealth management actually encompasses a lot of disciplines here. Now, having looked at the wealth management in brief, let us look at one of its subset, which is the portfolio management. The next slides on portfolio management were also the part of presentation which I discussed earlier that I gave during ICAI PDC in October. So if some of you would have seen that, my apologies for repeating the same, but I still thought it would be useful, and I'll try to be short and quick here. Portfolio management is focused on a particular investment or a group of investments within the overall wealth of the client. Now, group of investment here refers to various asset classes. It's not necessarily restricted only to equity shares alone, but also to assets can be debt, real estate, commodities, and art also. Selection is at two levels: the right asset class as well as the right securities within that asset class. Importantly, there has to be an existing portfolio which has to be managed. Unlike in financial planning, so portfolio management versus financial planning, I'm putting a point. In financial planning, you actually help the client build portfolio or build the wealth from scratch, or investments are done to meet specific objectives. In portfolio management, normally there is a defined strategy or there is a product which influence the investments within that portfolio. Now, defining the client's objectives and risk profile is much more detailed in a financial planning stage compared to at the product stage, which is where portfolio management activity sits. At the product level, it is more about assessing the specific product's suitability based on the client's risk appetite. So let's take an example is if one is running a portfolio management strategy of small cap equity, which is a high risk, it may not be suitable for a client who is looking to invest in PMS only for 3 years, right? So it is more about assessing the product suitability to his risk profile. So essentially, there are two aspects involved in portfolio management: research and fund management. So just as an automobile carries the engine, which is the heart, or the body carries the heart, I believe in portfolio management, research and fund management are the hearts. Research is the starting point to invest and required both at the asset class level, that is equity, debt, bullion, or commodities, and also within that asset class at the security level, whether sectors, shares, etc. So research essentially deals with what one should buy and sell and why. It is forming an opinion about the particular investment. Fund management, on the other side, is translating this opinion into two major decisions about when to buy or sell and how much to buy and sell. Now, both research and fund management involves art and science. Science deals with being more specific. It has processes, rules, and can be defined more accurately. While art can also be learned, it is much more complex web. In my experience, research is more science than art. We have academics to teach us specifics, and there are processes to guide us how to undertake research. Let's take an example that if you were to analyze a working capital intensity of a company, we would know what ratios to calculate, right? We would know how to calculate the ratios. We know how to look at the trends and what it means. The art part of research would be to understand how relevant those ratios would be in a given industry or a company. Fund management, on the other side, is more of art than science because it involves taking actual decision where there are no preset rules. However, without effective research, fund management will not be successful in generating good, adequate returns over long periods. So what are the skill sets required for both? On the left side, I have defined some of the skill sets, and on the right, there are avenues through which one can acquire those skill sets for research. Right? I'll not delve too much into this. In my experience of doing research for almost 15 plus years, now please don't catch me here, and there's no bias here, but I personally believe that a chartered accountant has some edge over some other financial professionals due to practical training or articleship which he is exposed to, and that gives him exposure to working of businesses and how also the operations connect to the numbers, to the final representation in the financial statements. I think that's a very important domain knowledge which is there. The other attribute which are also important can be supplemented either through short courses or workshops or reading. For fund management, the skills required are different. And this is where I connect portfolio to the first slide where I said portfolio management is more about art than science. The process of decision making in portfolio management requires understanding of your own behavioral prejudices. It requires a value framework, and over time, it requires developing your own investment framework, investment philosophy. Every asset class has its ups and down cycle. Learning from each and hopefully learning from the mistakes in each is what helps you build experience and with time convert them into the skill sets. I believe these attributes will help one develop a successful portfolio management practice. Having looked at the skill sets, let us briefly look at the career life cycle within the portfolio management. One generally starts with research analyst, with any of the firms, type of firms which are mentioned here. As we know, research is a foundation bed of within the portfolio management or any money management activity. It is important to spend a good number of years doing it before moving to actual fund management. Depending upon your passion, intellect, exposures, and ability, you may spend anywhere between 5 to 20 years and sharpening your research skills. The hierarchy level within research and fund management can vary depending on the size of the organization. One can start as associate analyst, senior analyst, and finally head of research. And similarly, on the fund management, we have assistant fund managers, senior fund managers. In large money management setups like mutual funds and insurance, we also see chief investment officers. And we know some celebrity fund managers and CIOs, and we have one among us also for couple of us among us, I'll say, who are doing fund management for last 25-30 years. And finally, if one has accumulated good corpus, he or she can take up investing full time on proprietary basis, right? So before this brings me to the last 2 slides of my presentation. So I believe in no questions here, and I can go ahead. Right. So for a successful investment framework, I believe there are 4 pillars. Right at the top sits investment philosophy. Investment philosophy actually requires you to understand what not to do. That's very important. So like for us, we have defined it that we do not engage into day trading or any trading of any sort, or even complex derivatives or derivatives to that extent. So we would not chase stocks, beaten down stocks just for the sake of high returns. So I'll say what not to do is much more important while having an investment philosophy. Analytical skill is more about trying to analyze number crunching, the balance sheet work, and maybe more akin to desk work, which you can say. Networking is an important pillar. However, I'd like to emphasize here that own homework is very important. So while we all have our own networks and professional networks and networks where we get good ideas, it is important to digest those ideas, understand the rationale behind it, and this links back to the basics of investing, and probably then going ahead with it. So while networking is important, I'll emphasize the importance of homework along with it. And finally, for a successful investment result, one needs to engage in the primary research to some extent, which either you call them business intelligence or scuttlebutt. And the importance of this pillar has only increased over a period of time. Finally, this is my own value creation process, which we have defined for ourselves. We call this as BMV strategy. What we do here is do an in-depth due diligence of business and then management. And only if these 2 parameters get ticked off, largely, we try and look at the valuation of the company. And only post that we look at investing. So normally the chronology does not change. What I mean is we will not look at valuations at the start point. There can be a change in chronology between business and management to some extent, because management change is a very important ingredient for future performance of businesses and then the stock performance. So management change do acts as trigger. But it is business and management which takes precedence over valuation. So I think this is how we have defined the value creation process, culminating into long-term investing for us. With this, I'll end my presentation and let me thank the entire think tank team and the coordinators here for having me here. I shall stop here with the thank you slide. Thank you. I shall stop the sharing. We can take up questions if there are any.
Hello. Hello.
Yes.
Yeah, Mayur, Sanjay here.
Yes. Yes, Sanjay. How are you?
Yeah, I'm fine.
Good to see you here.
Yeah, good to see you, sir. I just want to ask. Actually, investing, we generally think we should start early investment, right? But in our early years, when we start earning, that time we have a lot of things to do. Suppose you are into profession, you need to buy a office, or you are into service, you need to buy a home. Then that home EMI or office EMI starts. So how will you justify to invest in mutual funds or in this share market vis-a-vis paying EMIs? Is it better to repay the existing loan, or shall start EMIs regularly and invest part to these investments?
Right. So, Sanjay, thank you for a very fundamental question here. And you have touched upon many aspects. So, let me try and do this briefly here. First and foremost, understand that when you are investing in your own business, your own profession, uh, trust me, it is far more rewarding than investing in anybody else's business, which is stock markets, right? So I will not say that you are not investing. It's just that you are not investing in others' business, or you are not investing outside your own business. So first thing is you are definitely investing. That's the first point. And investing in own business will definitely give you more return on return rather than investing in others' businesses. Secondly, about investing into stock markets vis-a-vis paying off the loan. So I am a very conservative person here. So let me tell you very honestly, is according to me, there cannot be an investing till the time there is a liability. Then it is just a time. You are doing a time arbitrage, right? You are actually taking the arbitrage opportunity of maybe the time or the return which you can pay on EMI and or what you can generate on returns. To me, true investing starts only when the liability side do not have external liabilities, and the investing is truly surplus. Now, why it is important in stock markets is because when you're investing, and I think even Sandeep mentioned that point before, and we all have been experienced that before, is the volatility can be very high. There can be very long periods when markets may not give you enough returns, right? I think Nipun Bhai is among us and he can delve and give you more data points and highlights on this. But from what I remember is 1992 to 2000, just before the IT boom, markets were actually flat, largely there, and those were 7-8 long years of period, right? Even in 2008 fall, the Sensex was 22,000, and we didn't see Sensex coming back to 22,000 levels, 21,200 levels, till almost around, I think, 2015. 14, 15, 14. So there will be periods when you may not end up making returns into the stock market. So it is very important that time is on your side, and for time to be on your side, you need to be clear of your liabilities before, so that you can have a peace of mind and sit on that investment rather than trying to sell in panics. So I don't think there is a trade-off here. You may accumulate the surpluses through liquid funds or some debt funds in the intermittent time till the time your liabilities are due. but according to me, those are not investing in true sense. I had a slide on asset allocation where I mentioned about need-based analysis of. So over there, true investing is when you invest for the long term, right? When you are accumulating for short-term purposes, for some objectives, you are just it's an intermittent phase where you are putting the money aside. Does that answer your question?
Yes, thank you. Thank you.
Yeah, and you also had one question on the early stage. So yes, it's a big challenge. I have myself gone through that stage, and I believe still in that phase. We have to be patient and wait for the magic of compounding play. Let me tell you one data point. Warren Buffett has made 80% of his wealth post the age of 60. Right.
Yeah.
So let us understand that compounding works, but you have to be patient. You may start small, but when it starts to pay, when you are there for long haul, I think it will start to reward. You have to be patient enough for that compounding to play. Yeah.
Yeah. Thank you. Thank you very much.
So if there are no further questions, then I think I can sign off here.
Thanks, Mayur. Actually, that was really great presentation. Thanks so much.
Thank you to all. Yes.
Yeah.
There are few questions in the chat.
There are a few questions on chat.
I'm
Okay.
sorry, I was unable to see them.
Okay,
Can someone please
I'll just
help
read
me?
out to you how to create portfolio.
Yes.
I'm just reading out how to create portfolio, and with an addition allocation. So I think the question is basically how to create portfolio allocation.
So I don't know if I've understood it correctly, but let me try and give some color on that. So when you say portfolio, it encompasses, first of all, you need to have your need-based analysis very clear. And let me take the liberty of saying that let us focus on the long part of it, the long-term part of it, because that is where the creation of portfolio and its implications will matter the most. So I think equities and to some extent real estate have the properties which helps you to build, which helps you to fight inflation post taxes to the best of, right? So you need to have a combination of, I'll say, these assets. For me, it is only about equities. I'm not a real estate guy, or I don't understand that asset class as much. So, and for its various reasons, but so for me, it is equities, and I believe equities uh, most likely beat hands down on real estate also to some extent for very long periods of time. There will be phases when real estate can also do better, but over very, very long periods of time, equities do beat real estate also hands down. There are biases of location and geographies, but subject to that, I'm saying. Within the portfolio, one needs to have something which I call it as core portfolio. So you can have a combination of good blue chip stocks which are there. You can just look at that history, and you don't even sometimes look at the history in numbers. You must have experienced it around you, businesses and institutions. You get into them and you know them. So you build a core portfolio with a good weightage around that, and then obviously we all want little creams and cherries on top of it. Only eating rice dal bhat does not satisfy us, and that's a normal human behavior. So for that portion of those creams and cherries, one should stick to, I'll say, mid cap mutual funds, which gives you a good perspective because they are being managed professionally with people who are there in the market for long periods. and mid-cap funds, the volatilities and risk profile are little higher than the large ones. You can look at having a good mix of one or two good long history of mid-cap and small cap or small cap funds, so that completes the basket of having that core or satellite portion in that, because that portion is not very easy to manage if you do it on your own at the stock level. uh, you know so I think that broadly is how I would look at.
And one more question. It was like, if someone has a conservative approach and doesn't want to be a Warren Buffett who has made his fortune after the age of 60. So if someone is a conservative approach, has a conservative approach, what should be your suggestion on allocation?
uh, so are we looking at talking of equity allocation, or
I
or are we talking within the
No, full
equity what
allocation.
should be? Sorry.
so
I'm talking about full portfolio allocation with a conservative basis.
Yeah, so sir, let me tell you one thing here. Let us understand what is the enemy you are fighting, right? When you say conservative, it is conservative against what? If you do not invest in appreciating assets for your needs which are higher than longer than, I'll say, 5 7 years, by not investing in appreciating asset like equities, you are actually taking money from your own pocket. The enemy you're fighting is inflation, and the returns post inflation and post taxes is what is crucial, right? So by being conservative, we look at equities as risk assets. Obviously there is a risk here, I'm not at all denying, right, that part. But not investing in equities is a bigger risk also, if you have periods of horizons which are longer than 5 7 8 years, because you will not be able to protect the purchasing power of money. So I believe all the money which you require for longer periods should be allocated to equities. Uh, Now I may sound very aggressive here, but trust me, periods of 5 7 8 years are very long periods where inflation and will eat up into your ability to stay put. So imagine uh, people in US and developed countries who retire with $1 million as retirement funds in 2000. They thought they were millionaires, and they could have earned, they could have done a living on that corpus. What has happened to them in 20 years? That plight we don't even can't even imagine. And they would be standing against the wall because the rates of return have been lower, and they cannot live their living in that 1%, 1.5%, or even in few cases 0% rate of return uh, uh, over the life cycle, with nothing to fall back as income. So conservatism, according to me, is very I'll say misunderstood word. I'll say anything which you do not require for 7 8 years, you should be in a position. You should allocate to appreciating assets. Uh, Further, you should be in a position to even roll over that period, because while I may say it is 7 8 periods, 5 years, 6 years, 7 years, 8 years, whatever you can take it, it is not necessary that the money you at that point in time the markets are conducive enough for you to withdraw the money for your needs. So you should be in a position to roll over that money for further periods. So essentially, that is what will help you to generate good wealth over periods of time, and rather protect your money over long periods of time. So I'm sorry I did not give you any percentage or indication, but that's how I would look at it.
yeah,
No, that
that's
was that was cool.
yeah, that's something we always have a disclaimer that it's not a suggestion. You do your own study and research before you invest, and there is no opinion which is being provided here. Yeah, I would look forward for another question. Maybe Dushyant, you want to ask something?
Yeah.
Yeah, Dushyant.
Mayur.
Yes.
You have given a very good insight into this portfolio management and skills and all that. Now I'll come to a more practical question in the sense that what is more advisable, investing through mutual funds or investing through PMS?
Sir, you are trying to either ask me whether apne kulari pe main pav maru ya na maru. So let me tell you, I believe at a certain level of corpus, uh, investors, what I have seen is there is a need to move to PMS. There is a need to have PMS into the portfolio. I'll say it is more a function of the corpus sizes sometimes, because uh, at lower levels of corpus, and anyway, now the SEBI itself has defined for portfolio management, you need minimum 50 lakh rupees, right? And let's say even if you have 50 lakh rupees, it's not going to that you're going to put all the entire 100% into one basket, right? So you need a much larger corpus for one needs to start looking at PMS now, and I think SEBI is right in his perspective over there. I'll say mutual fund is a very, very good, I'll say tool, a good investment avenue to start building your experiences and to start building your, I'll say, life cycle stage to understand equities. And there are many products which helps you to do it right from through a combination of equities and debt and all the way to sector funds which stand at the highest on the risk profile. So you can build through mutual funds. Mutual funds essentially provides at a very small fee the services of a strong professional who's day in day out managing money as little as 500 also for you. So I think it's a very good mode to build a portfolio. And after a certain stage, people start looking at PMS, because they need concentrated strategies, or they need, I'll say, differentiated strategies, sorry, pardon me, which are different from a typical mutual fund. But sir, honestly, let me tell you here, if you look at the returns of PMS along with mutual funds, you will not see a very great very, very big alpha which is there. Yes, there would be obviously a couple of strategies which will generate, right? There are always in mutual fund also, there are few strategies and schemes and which will do much better than the rest. But we are talking from a large percentage here. You will not see a very big deviation. Why is that? That is because in India today also there is a lot of edge on the active management which people can do, and our mutual fund industry have had some awesome investment officers and fund managers who are doing phenomenal work over the last 20-30 years. While I may sound like I'm putting X on my own leg, but then I believe mutual funds should be there as part of the portfolio. And at higher levels, one should start exploring PMSs. Again, the choice of fund selection or fund manager selection has to be very conservative based on the philosophy of that fund manager. And I think that is where people do not spend enough time on. They look at the past returns which are generated similar to mutual funds over the last 1 year, 2 years, 3 years, rather than the way it is being managed. It's a much more personalized experience. So people with higher corpuses would want that kind of situation. So I think there is a room for both of them to coexist rather than saying one over the other.
Yeah, great. Thanks, Mayur. Good
Thank you.
insight.
Thank you.
Any other question from anyone? Okay. Just one sec. Yeah, Menak, do you want to ask any question? I just happened to see you.
No. Just it came by mistake.
No worries. Like I just thought I'll just check with you. Okay, I think we answered all the question. Somebody actually raised, can you please explain each point in details? But that's okay. I think, yeah, that's all. Thanks so much, Mayur. That was really great. And we had a good insight. Do you want to share anything else you feel that you want to speak about? Otherwise,
No, so I think that's it. Anybody can get in touch with him, and I once again thank the entire think tank team, and especially Manojji for having me here, and uh, in the presence of esteemed members like Nipunji and others. Thank you very much for the webinar opportunity, and right, that's it. Thank you.
yeah, you can keep coming and speaking about anything. If you feel that you have any thoughts and you want to share to the wider group, you can keep coming to this, and maybe you can just let us know, and we'll let you speak for even a shorter duration whenever it is.
Sure, sure. That will be great. Thank you.
Yeah. Okay. Thanks so much. We'll just take a 2 minutes break, and hi, Sandeep. Sandeep, you're on mute. Can you unmute yourself?
Aditya, are you talking to me?
No, sorry, Sandeep Bhat. Sorry.
Yes.
Just one sec. Sandeep, can you try unmute yourself? Sandeep Bhat. Yeah, perfect. Can you speak?
Yeah.
Yeah.
I'll have to actually put on this thing, the presentation.
Yeah,
Just
that would
one
be good.
second. Have you given me rights?
Yeah,
Anupam?
I have given you rights. Yeah,
Sorry,
this is Aditya. Yeah. Yeah, we can see your screen.
Yeah. Okay. Hi. Sorry, I'm at a place where there's some work going on. You might encounter some banging and things like that. Uh, Extremely sorry for that. I'll quickly run through the IPOs which are likely to hit the market, and prior to that, in fact, some uh, flavor of what has really happened already. Uh, MTAR Technologies, as you would be all aware, got oversubscribed by 200 times, which is the second best, um, you know, subscription which has happened this year. The number of times it has been subscribed in terms of the NII. Uh, Retail has been lower, but QIB and the NII portion has been quite substantial. Uh, Possibly because of the segments which it is dealing with. Right now, there's not much of competition there. Competition will come in later with the form of MNCs coming in. Uh, let's see how it actually lists. Uh, so the listing is around the corner. Ease My Trip planners, it has been oversubscribed quite substantially again. But then, in fact, even the last time over, we had seen that this is an offer for sale, and the retail portion, though it is again oversubscribed 70.4 times, it all depends on what the listing price would be. Uh, let's see again how it gets listed on the 19th. to talk to you about what is coming down the line. In fact, the opening date is the 17th of March. Suryodaya Small Finance Bank, and unfortunately for them, the markets are down. Uh, Again, the yields have been going up, which are not really a favorable situation for banks and NBFCs. Uh, and on top of that, we have the problem of COVID, which is again peeking its heads again, and to an extent, possibly this could hit the microfinance section again. Unfortunate I'm saying again is the reason being Suryodaya Small Finance Bank has to get listed as per the regulatory requirement, and they have no opportunity to really uh, take this forward, and they are trying to list it. The RHP is very clear on this, that but for any other regulatory requirement, we would have pushed the whole thing forward. But from their point of view, they are going ahead. Now, I've told you all that is negative for the um, Suryodaya. For example, the COVID situation I've already mentioned. They have a provision of 10.87 crores due to regulatory requirements of 10% provisioning norms, a 5.51 crore provision which they have specifically provided, and an increased floating provision on their JLG loans, which they have taken from 1.5% to 2%, and that makes up about 13.3 crores. And over and above everything else, in September 2020, they have had to actually take a subordinated loan to make good their working capital requirements. So their capital requirements. So our cash flow requirements. So they have been in trouble, as is all the NBFCs and all of the other people as well in the microfinance sector. The cash flows have due to the problems of COVID, their cash flows obviously have been negative. Again, they have also specified that the shares are being issued at a lower price than those issued in May 2020. So that's not a weakness, but that's something where they would not have loved to do it. Neither would be the subscribers to the May 2020 subscription. So it's unfortunate again for them that they've had to do this. In the longer term, I don't think that could be much of a problem once the vaccine rolls out and situation comes back to normal, except for the fact that the yields are increasing. They might increase even further. For example, possibly they could be looking at, or we would be looking at something like a 6.7% yield. Right now it's about 6.2324. Sorry, the left hand side you just ignore. I should be taking that off. It's relating to the earlier one. On the right hand side, the risk factors. There's a large pending litigation against directors amounting to rupees 4,377 crore, which is a big risk indeed. I've already talked about the other thing where in terms of capital, they have been stressed for that capital. Promoters have gone ahead and pledged their shares and taken finance. all in all, it's not a great situation. Business for Suryodaya is concentrated in Odisha, Maharashtra, and Tamil Nadu. Maharashtra, Tamil Nadu, you would see that there have been spike in cases again, and that could impact the, the business going ahead. All in all, what really transpires is there's a business cycle. So if they are in trouble, their depositors also could be running away from depositing money into Suryodaya. So it's a situation which is not too good. I hope for the sake of the NBFC and the MFI sectors, the issue goes through properly and is not in default of the subscription. So that sums up the whole issue. Kalyan Jewelers have not had any problems so far, except the COVID problem during the shutdown. Their brand image is quite good, and they came up with a roar in Mumbai actually. Their opening date is 16th, whereas the IPO closing date is the 18th, and they are issuing shares at 86, 87, which is quite okay with in terms of the rate. So as I said, brand image is good. The only problem which they could face, and this is what has happened to all the sectors, in fact, is the migration of workers, and they tend to contract a lot of work to others. If the contract work gets impacted, their delivery schedule gets impacted, quality of workmanship gets impacted, and that is one of the things which people should keep in mind. Again, the left hand side, you should first contingent liability provisions, small ones for service tax as well as sales tax, but to a larger extent, there's a quite a bit of portion where the major portion being letters of credit to banks, standby letters of credit to banks of 219.76 crores, whereas the counter guarantees to avail of metal gold loans are to the extent of 1,308 crores, which is in terms of Kalyan Jewelers, it's not much, but it is a risk. Again, Kalyan Jewelers also has businesses in the GCC countries, which is the Middle Eastern countries. And this issue, in fact, is being also marketed in the US. So we don't see any problems as far as the subscription of, to that extent for Kalyan Jewelers, sorry. I've done this in a rush, and excuse me for the title and other things. Again, the title should be Kalyan Jewelers. So the issue is that they can actually market this to people in the US. They are registered for that, and I don't see any problems for Kalyan Jewelers getting sufficient subscription for this issue. The only other thing is claims relating to direct and indirect taxes, total 433.94 crores, which are pending. There are a couple of more public issues down the line, which are Nazara Technologies, quite heavily priced, but at the same time, there seems to be quite a lot of interest in this as well. And in terms of the lead managers, there are ICICI, IIFL, Jeffries and Nomura. So, there could definitely be anchor investors who would actually support this issue. The IPO listing date is quite far away even now. And looking at the scenario, the only issue which stalls the overall progress of IT companies, and you might have seen this for the Nasdaq as well. The regular companies, which is the cyclical companies, and those relating to the non-IT sector, which is the Dow, have started performing well because the overall transformation which is happening is right now to see that the GDP growth is better, vaccinations are there and will take care of the problems which are on hand, and but for the other problems which are there, the issue was that the Nasdaq had gone up substantially more with the people working from home, people going on to the OTT platform, and things of that sort. So those are things which are calming down. So IT as a sector, and we should also look at what is happening to the dollar because of the stimulus again of 1.9 billion dollars or trillion dollars from the US. It's a possibility, and I'm not completely ruling it out. There is still a possibility that if the dollar goes down further, it could go down to about 69.7. Currently, it is around 72.4, 72.5. So, IT sector, always a defensive sector, but some of the issues surrounding what is really happening right now, just be a little careful on those sectors. The other one is Anupam Rasayan, which is due to open on the 12th of March, and closing date is 16th of March. This also seems to be having quite a bit of interest. In fact, all except Suryodaya, for that matter, might have sufficient interest for investment. The only view from my point of view is when such a thing happens, there are a lot of IPOs coming in to take advantage of the high prices. What really happens is the secondary markets really are but may be peaking out. So you need to be sufficiently cautious to see that you are not overexposed in the markets at this point of time, even in terms of the IPOs, because IPOs which look good at this point of time can change direction any point of time if the secondary markets collapse. So what has been happening in the secondary markets, they really with the momentum, they open up much higher and tend to be closing lower. So that from that point of view, the momentum has not been sufficiently reflected in the secondary markets. So the secondary as well as the IPO markets, you need to be very careful. Now, without doubt, this slide always gives you that, or rather gives me the comfort as well, that you should be talking to your own stockbrokers and investment advisors in relation to investments in the IPOs or in the secondary market. That's it from my side. Aditya. Aditya, are you there?
If I can ask one question, how did you arrive at the currency rate?
I'm sorry, I couldn't hear you.
Yeah, so I just wanted to know if you can help me and share more insight about how did you drive to the exchange rate prediction?
Oh, I'm
Your
sorry.
assumptions?
There are two things. If you look at it, one of the things which has been happening is the Indian rupee had gone up to around 77.1. You know, when all the problems started, somewhere in August, they were you know stimulus packages across the world. And what stimulus packages across the world do is that there is deficit financing in the country in which you have these issues, or where there is stimulus. So the dollar is pumped in, which means the supply of dollars is more than the demand for the dollars in that particular country. And from 77 levels, you would have seen the depreciation of the dollar to the 72 levels. So that is one factor. Now, the $1.9 trillion stimulus again by the US could be one of the things which could, impact and lower the dollar prices. And one of the reasons why I'm saying, there is a disclaimer is that it's not 100% sure what I'm saying is going to be true, but there's another analysis which I had done, in fact, just recently, and the factor is that if the dollar is to go down, it is going down in a pattern, and from the technical analysis point of view, it's going down in a pattern where the resultant target is 69.7, purely on the basis of technical analysis. So at 72, or I'm forgetting the number, but at 72.31 or something of that sort, if it falls below a particular level, there is every chance that the dollar could go back to or go lower, and rupee will strengthen to something like 69.7. There's one more factor to this. I'm not talking that as an immediate effect. I'm talking about it from the medium to a slightly longer term perspective. Not very long, but I think 2 or 3 months maybe it could hit that levels. Again, one of the factors which I'm trying to tell you on this one is that in terms of the yield as well, if the yields go above a particular level, they are likely to hit a level of 6.7. Right now, they are approximately 6.2425. These are all technical analysis, and these are things which I've analyzed on the technical analysis basis.
Sandeep, bit of a side question.
Thank you.
Yeah,
I'm sorry.
Yeah, bit of a side question. Now, if you are saying that the rupee will strengthen to something like 69.7, then how the gold will behave?
In fact, the gold, in fact, is not moving at all, unfortunately, because there's a substitute for gold, and which is the bitcoins. If you have seen, bitcoins have replaced gold as the standard, investment opportunity, and has moved up from something like 30,000 to 56,000. In the short term, um, Bitcoin will remain a slightly bullish, but gold is definitely not, going to go down much lower. I don't see, gold dipping like it had earlier, from the 2000 levels to the 1700 levels. I don't see it going below the 1500 levels, at least.
So you feel that it can go down still further about $100, $200?
About $100, yes, possible.
Okay.
Okay.
Can I?
Yes,
I'd just like to add a couple of things to what Sandeep ji said. On the question on dollar, I think broadly the anticipation in the world right now is that the DXY, the dollar index, especially if COVID doesn't scare everyone out of their wits, the expectation is that 91, 92 could be the start of a fall. Now we've had a couple of months where this theory has not played out. But if the dollar index falls below 91, that could be a big move against the dollar and for emerging markets. And we're all waiting for it. In fact, that's what started off the rally in equity markets last year. When the dollar went to almost 102 and then started declining and came all the way to, I think, 89.5 or so. So if that fall continues and we don't get a scare, then I think the rupee would actually appreciate to levels that Sandeep ji mentioned for sure. That's the biggest view right now. I think everybody is short on the dollar across the world, hoping and praying that the next couple of years would be tremendously in favor of global growth. If that happens, minus what happens in the next couple of weeks, because we are playing at very sensitive levels, I think that rupee touching even 67, 68 is very, very possible. And as we know, that the inflation has been low for the last couple of years, so that's going to possibly support such a move. So I just wanted to add that. One thing on the IPO, I've worked very closely with Mr. Bhaskar Babu, who's in Suryodaya, who's the managing director. He was in Cholamandalam with us. A very, very strong, decent, conservative, South Indian gentleman. I think, Sandeep, I don't know whether you agree or not. I think most of the IPOs that are out in the market right now, including especially the chemicals companies, are priced, I think, beyond belief.
Absolutely.
I've been wanting to say buy two or three chemicals IPOs, etc. But I frankly have the guts. Easy Trip. Guys who've not sort of demonstrated growth in the last couple of years, but more importantly, belong to industries where they definitely have a very, very strong foothold. Anubhav Rasayan has a very strong foothold. Craftsman Auto has a very strong foothold. But then you don't buy IPOs at 70 times and 80 times of earnings. And irrespective of how they grow over the next couple of years, it becomes difficult to understand. Only, I think, Suryodaya, not only from the PE point of view, because I think PE maybe for them may not be relevant. From a price to book of 2.5 times, maybe Suryodaya, and especially because I know the gentleman and I've worked with them very closely. I know how conservative they are. That's possibly the only IPO I would look at favorably.
True, definitely. That's something which is absolutely true. In fact, I agree with you on both accounts. And that is one of the reasons why I was cautioning everyone about the IPOs which have been coming in. And specifically with the reason that I don't, I've gone on record as saying, I don't like IPOs, which are actually not IPOs. They are offer for sale. And that is something which, is a no for me. What is the money will go into the hands of the promoter. What happens thereafter? Is it going to increase the GDP level of the country? Is it actually going to increase, the potential growth of that company in the future? It is something which I'm really, it's hard to believe and hard to digest. And that's one reason why I've always been saying, that's not the best thing. And I agree, the prices of the IPOs which are coming in are extremely high. Extremely high.
Sandeep, one benchmark which we use is that the company should demonstrate rate of growth, even if not in EPS, even at the top line level, similar to their, P ratio, if P is what you're using as a thumb rule, right? I don't see any chemicals companies, I mean, there could be pockets of products in each chemical company, but I don't see any, bulk chemical company growing at 70, 80% and all that, CAGR.
Right. No, in fact, for each and every company, whether it is in the form of a P or any other ratio which you pick up, those are extremely high. So that's one thing which has been, haunting me all this while. Suryodaya is low, 2.5 is actually not bad, and not too high. They, if you compare it with others, it is actually low. The only problem, why is it low? Because the whole sector is in trouble. Because I know microfinance companies in and out, and they have been badly hit across the board. And if there's a, the COVID-19 problems arising again, and in Maharashtra, it is actually going to impact a lot, because if Maharashtra is impacted, Suryodaya is impacted. So all in all, what I'm trying to say is the whole sector as such has been going through a curve which is downhill. It's been very difficult, and mind you, I'll tell you something which I know about the microfinance companies. Banks have been lending to microfinance companies only if they have a or a above A rating only. They are not providing any loans to even triple B stable or triple B minus stable. So where are the other companies? How are the other companies supposed to grow in the microfinance sector? They are not willing to touch these companies at all. And nobody is actually putting in money into the microfinance companies by way of equity capital. That's the second thing, which is really hampering what are they calling impactful investments, which is what the government wants. It's a contradiction in itself.
And Sandeep, if I can add something, the recent issues, the way after listing the share prices have gone up phenomenally in so many issues, I think probably might be making the new IPOs to be priced on a higher side. Looks like, everybody wants to get a quick share of the pie.
Agree with you. And that's the time when, greed takes over. And when greed takes over, the market turns around and, teaches the greedy on certain subjects. So, that's what I have been cautioning people about.
So my only one point here would be that irrespective of what we say, Sandeep ji, I think a lot of people would apply, especially because there's a lot of excitement around chemicals and automation. And I completely agree with what you said, actually, especially on the balance sheet squeeze because of, what's happening. And plus elections, right? Election time, microfinance companies are the first ones that come in trouble, right?
Exactly.
So I think I would suggest that if you've applied and if you've actually gotten subscribed to, I would suggest sell on listing, especially if markets hold up, because I don't know whether next week markets are going to hold up. But if you get any premium, I would suggest that you exit.
That's right. That's right. Absolutely true.
So, but at one point we are saying that a dollar will depreciate and rupee will appreciate. That means and more checks will come to India. The equity, the funds will come to India also. isn't it contradictory because it's a liquidity-driven rally? More checks keep coming or more funds keep coming from US, and that is where the US dollar will depreciate and rupee will keep appreciating, and that will be definitely be invested in risky or maybe bonds or whatever, but the funds will keep coming, so the valuation will not be valuation will not be an important parameter to a large extent.
I don't fully agree with that, because dollar might keep coming in, but will trickle in. The only problem, there are two problems actually. The yields in the US are going up, so the dollar inflow which is there possibly might reduce to some extent. Number one. The yields in India as well will also keep going up if the dollar inflow keeps coming in. So, if the inflow comes if inflation goes up, and inflation of the oil, in terms of even the oil prices, for example, if those go up, inflation goes up, RBI has no alternative but to increase rates. Then what happens? Then the profitability of companies, is impacted. Why is it that the profitability of the company is so high right now? Because of the low rates of interest. The whole thing changes. The equation completely changes if inflation goes up and the yields in India as well go up. And as I have been saying, it is quite possible that the yields could go up to around 6.7.
Sir, as you rightly mentioned, and I totally agree with you, but right now the scenario is totally different than what we have seen in the past or we have read in the books. Now, situation is that you are, or even I am worried about the US yields are going up. Yields are going up because somebody is selling a bond and they are saying that I look at a better growth prospects on the GDP side. So let me take a little bit higher risk, move to a riskier asset. If Fed is hand on that I want to pump more money, they will. Why can't they go and buy these bonds itself and reduce the yields?
It's quite possible that they do it, but when in theory, actually, there's a big difference between theory and practice, actually. And theory and practice, and by theory and practice, I mean by technical analysis and fundamental analysis or historic prices. What really happens in technical analysis is, nobody wants to buy. Nobody actually wanted to buy at 7511 levels, and nobody wants to sell at this level. So it reflects a contrarian view. So the dangers, the dangers are there. Something like around 15,600 is what I had expected in terms of the Nifty. It has almost reached there and has shown resistance at those levels. It is not ready to go above those 15,400 levels, and that sign itself, the weakening momentum, is something which is very, very frightening.
Yeah, I agree with you, sir. Thanks for your valuable insights.
I can't hear you. Somebody talking there?
No, actually.
Yeah, thanks for valuable.
Yeah. Thanks, Rajkumar. Yeah. Rajkumar was appreciating your statement. Yeah.
Okay, thanks a lot.
Okay. Thanks, Sandeep. It was really a great presentation, and thanks everyone.
Aditya, just repeat the disclaimer. That's it.
Yeah. So the disclaimers are always there. We don't recommend anything. It is your pure judgment. You need to go through everything. any document which you feel you need to go to and take your own investment decisions. No one can guide you. You are your best
Judge.
judge to invest in the shares, or you want to stay in the kind of investment you're already in. That's better. So learn from things and take your decision. Okay, thanks everyone
Thanks.
for the active participations, and this was really great. We look forward to have sessions next week. Same time, we generally, as usual, we have our Saturday sessions when we will have due diligence, private equity, venture capital, financial reporting, presentations by different speakers who are well known into the industry. In addition, we have a small session which we have planned on 21st. This is around how to read equity market. It's a small sessions on Friday, Sunday evening. In case you are interested, do join. Uh, thanks everyone for all, and have a
A
nice.
special thanks to Sandeep for coming in and giving out his views. In fact, not only I'm not saying this for his supporting my views, but I'm talking of his presentation and his talk as well.
Yeah,
Thanks a lot,
definitely.
Thank
Sandeep.
you. Thank you so much, Sandeep.
It was really great presentation by all the speakers today. Thanks so much, and have a nice weekend ahead.
Yeah,
Bye.
same here, and please take care of yourself. I know the vaccines are around, but